market was priced for a soft landing, was very enthusiastic about a soft landing. And we had called this year a roadmap to recovery.
The likelihood of a soft landing, a garden variety recession, even maybe a small chance of a hard landing, that's all there.
Central banks now have to make a judgment on how persistent those upside surprises are going to be.
We're in the camp of a couple more rate hikes for the Fed, but not giving up on the disinflation story.
If the Fed really wants 2% inflation, they have massive amounts of work in front of them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Back after a long weekend with futures negative 0.8% on the S&P 500. TK, I've got to say, the data out of Europe, a whole lot better once again.
Well, out of Europe, it is a surprise it's better, but you don't see it in the tape with the VIX back out to 22.35. It's an adjusted tape, and I really suggest, John, we need to reset on this Tuesday after the back and forth. I think strategists getting out front. Yes, Europe good. Mike Wilson's got some real caution.
I need to reset with some of the earnings as well. We'll get to that Mike Wilson note in just a moment. Through this morning, going to hear from Home Depot, Walmart, some of the big retailers reporting this week in America. Lisa, we get Home Depot right now.
So less bad. I guess that was really the issue in terms of the decline in the year-on-year sales. To me, the most interesting aspect, though, is they're boosting their dividend by 10%. This, to me, follows on what we've seen from other companies, basically saying if we have extra cash, we're going to return it to our investors. Still, they did see a decline. Their net revenue did beat. I mean, honestly, all around, it's better than expected in many areas, and yet still facing a lot of potential headwinds.
To invest $1 billion extra annually in frontline staff, Tom, the extra staff investment to start in the first quarter of fiscal 2023. I imagine we'll see much more of that too.
That's going to be the investment part, and the look back is maybe pretty good, but the sum of the headlines is actually, to me, pretty negative as well. From a 317, 318 close a long time ago, John, Friday, and you come down now to a center tendency of about a 309, 311. The guidance forward here, and particularly on revenue, I think is what I'll have to focus on.
The stock is negative in the pre-market by about 1.9%. We'll pick up on that story in just a moment. Equity futures negative 0.8% on the S&P 500. The broader price action looks a little something like this. If you look at bond yields, much higher by 6 basis points at 387.67. The data out of Europe on the services side, a whole lot better, including from the UK. The UK data improves on services. UK gilt yields at the very front end of the curve, higher by 12 basis points. So this lift is across the board. Bit of dollar strength out there for you, Tom. Euro dollar 106.49.
Are we out to 4% watch on the U.S. 10-year yield? I mean, this is part of this shift in this great Tuesday reset that we're having here. Whether you look at equities, bonds, currencies, or commodities, Ed Morse to join us later on oil. John, to me, it is a yield reset.
I couldn't agree more, Tom. Out to 4%, getting close on a 10-year. We're through that level on a 7-year, Lisa. On a 7-year note, we're through 4% and up 7 basis points on the day.
This is a global move also, and we'll get into that in just a minute. I do want to just reiterate what we got from Home Depot. Basically, a kind of muddied picture here. The U.S. doing better than good, the rest of the world perhaps less so, and that really is what stands out to me because the declines are much less and less than expected in the U.S. versus globally, where there were some disappointments. To me, I think it'll be interesting as the heart of retail earnings kick off. We've got Walmart at 7 a.m. Eastern. How much do we see them able to pass along the price increases to the consumer versus how much more they're going to have to pay to staff? That whole $1 billion in hourly frontline staff really from Home Depot really speaking to this. At what point do we see that margin compression? We get Target, Dollar Tree, Kohl's, Lowe's, Macy's, Costco all in the next couple of weeks. Today, President Biden is meeting with Polish president and other NATO allies in the Eastern European flank. The key here is, as they celebrate or not celebrate, memorialize a year of this war in Ukraine. How much more aid is the alliance going to provide to Ukraine? The U.S. announcing about $500 million in additional aid in the surprise visit to Kyiv. And just building on what you were talking about, John, with the PMIs, the data that we got out of Europe. In the U.S. at 9:45, we get the latest read, the S&P Global Manufacturing and Services PMI in February. In Europe, we saw the biggest jump in Eurozone business activity, the composite PMIs, in 9 months. And this really speaks to this is good news, bad news, because you're seeing that yield in that 2-year term lift.
The manufacturing is still a little bit soft over in Europe, but certainly the services component of that PMI really starting to improve. Who remembers this this conversation with Bloomberg's Francine Lacqua and the Credit Suisse chairman back in December on outflows. Take a listen.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
The outflows have stopped. Reuters reporting that Switzerland's financial regulator is reviewing those comments made back in December, Tom, on outflows. Had the outflows stopped? What did he know? And was that an accurate representation, characterization of those flows into and out of the business?
Every regulatory cadence is different. There's been a huge mystery here of what Swiss regulators do with their two big banks, UBS, Credit Suisse, all sorts of Zurich and cultural baggage there. And this seems to be one of their ways to get in. Very different than the United States. I would suggest different banking authorities in the United States, if they were New York domiciled, would be very different. I would focus, John, on a price to book 0.16. Oof. I can state to you I've never seen that statistic.
Brutal. Lisa, the stock's down 7% in Switzerland. We're trading in and around 250.
It also raises the question of how much more have some of the withdrawals continued, right? I mean, they've basically been saying things have stabilized. They have continued to say that. So at what point are we getting misinformed, even to this day, when they say they're retaining some of their clients?
Plenty of coverage through the morning on that. Credit Suisse at 258. I promise you that note from Morgan Stanley and Michael Wilson. The bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. Ben Laidler joins us now, global market strategist at eToro. Ben, if we can just kick off by asking for your comments on that, because I imagine you might see things differently. I'll read it again. The bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. What do you say to that, Ben?
I guess I respectfully and partly disagree. I think this rally has been very fundamentally driven. It's been this easing inflation and interest rate shock. And less bad growth data, which you've just been talking about. I think that's very fundamental. I guess what I would agree is there's going to be a pause. I mean, you cannot annualize the degree of performance we've had this year. I mean, that would take you to twice what the S&P 500 has ever done in a year, and maybe some of the disruptive tech names, which are up on average, by a third this year, even more than that off the October lows. I mean, with bond yields now rising and investor sentiment, maybe not as depressed. I mean, those are absolutely due a breather.
Yeah. Ben, just as the VIX is a measurement here, and I know we went out to a 25 level in December, but we've had a spike up in the VIX showing the angst out there. We're back above 22.40. Does Ben Laidler shift from a measured bull to a more outrageously optimistic bull as the VIX adjusts?
Well, I think we can argue that the VIX is probably a sort of broken indicator here, but I mean, we would definitely be pulling back on some of the higher risk elements of the market here. I mean, I just said, if you've been lucky enough to ride that sort of 50% disruptive tech rally off the October lows, I think now is the moment to rotate into cheaper, more cash flow, sort of defensive bits of the market. I think October was the low. I think this is very fundamentally driven, but these higher bond yields are beginning to put a ceiling on valuations. And what was extraordinarily depressed in investor sentiment 3 or 4, months ago is, now less depressed, and that has been the sort of gasoline that's been poured on this rally in the last in the last few months.
Ben, is this a question then of leadership in the equity rally and where you see it coming from and a shift there, or is this a question of you becoming perhaps less optimistic than you have been in the past because of the challenge to the leadership we've seen year to date?
I think the drivers are just different. We've seen a lot less growth risks. I think earnings are becoming less of a concern now with all the data that you're seeing. But we're seeing a cap coming in from valuations. And the rally this year has all been driven by valuations. With bond yields now rising, our sort of fair value PE for the S&P 500, it's down at 15, 16 times. It's not sort of 18. Now, that's an issue in the US. That's much less an issue in the rest of the world. Why is Europe being the best performing region in the world this year? Yes, You've had a sort of growth story, but you're coming off, 11, 12 times earnings. So I think, it's cheaper, more cash flow generative stocks that are less exposed to this sort of potential valuation reset.
Ben, I got to be rude here and take every advantage of your time as an award-winning strategist at HSBC. They're in the news here. And I'm fascinated, Mr. Laidler, if you feel you can envision a separated HSBC into their Asian business, which generates 72 or 78% of profits, and everything else in London. Can Ben Laidler believe there could ever be separate HSBCs?
I don't know. I think history tells you that when you have these, these big companies and you try and split them up, especially in regulated businesses like banks, it's not to say it's impossible, but it's certainly it's certainly difficult. But the broader point there, I think, they reported seemingly great numbers today, right? And that's been leading. Banks have been performing very, very well. You touched on it with CS, which hasn't been performing well, but this combination of strong earnings beats, higher interest rates, and well under book value valuations is a pretty attractive proposition. And we touched on Europe earlier. It's been leading the European rally.
Let's say you addressed that question, Tom, without addressing that question. Did you like that?
Did I address it? I addressed it. I didn't want, I want Ben to come back.
Of HSBC, Ben Laidler there. Ben, thank you, sir.
Ben, thank you.
Ben Laidler of eToro. As if he was ever going to comment on that, TK.
Let's review this. Ben Laidler was at HSBC. Ben Laidler was at HSBC. He alone, sort of like Mike Wilson last year in the gloom.
Sure.
Ben nailed the Christmas bull market a couple years ago.
I think it was 2018.
Nailed it. And then, he went to London with eToro and a separate thing. But he's lived HSBC. We get Max Kettner on. He's not going to give us a straight answer. I'm hoping to get an answer. I'm hoping to get an answer from Ben Laidler.
He's a classy guy. I don't think it's about to, throw any mud at his old employer, Tom.
Can you imagine a separated HSBC? I can't.
We've been talking about it for how long now?
A century.
Years and years. On the bonus pool over at HSBC, did you see that, Lisa? The lowest since 2020. The bonus pool shrinks again, and we've seen that from bank to bank, bank to bank.
So how do you retain some of the talent if you have this kind of pressure at a point when...
How do they do that when they raise the dividend 10% and they show record profits, as Ben mentioned? To me, it's out of body.
Are you acting on behalf of the HSBC employees?
No, Max Kettner called me and said, say something, Tom.
Well, you've said something now. Futures down about 0.8% on the S&P. To kick off a brand new trading week stateside, yields higher across the board here in the Treasury market, abroad as well. Bunds, gilts, take your pick. The data improves on the services side. Once again, your 10-year, 387.28 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin has delivered a defiant message on the war in Ukraine. In his first State of the Nation address in almost 2 years, Putin vowed to continue the faltering invasion until Russia has achieved its goals. He also threatened a backlash if the U.S. and its allies supply Ukraine with long-range missiles. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. And HSBC will consider a special payout after the sale of its Canadian unit amid an ongoing battle with Ping An Insurance Group of China to break up the business. Fourth quarter earnings rose 92% to $6.83 billion, beating estimates. On the credit side, the bank's results suffered as expected credit losses almost tripled to $1.4 billion in the quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Putin thought Ukraine was weak and the West was divided. As you know, Mr. President, I said to you in the beginning, he's counting on us not sticking together. But he's just been plain wrong. Plain wrong. And 1 year later, The evidence is right here in this room. We stand here together.
Approaching the one-year anniversary of Vladimir Putin's invasion of Ukraine. That was President Biden during a surprise visit to Ukraine. And Tom, phenomenal to see an American president on President's Day in a war zone without an active American military presence. That's different to what we've witnessed over the last few decades.
I thought it was a huge deal. We make jokes about February 20th and tomorrow's George Washington's birthday, but the symbolism, John, is really, really tangible. And, I thought the American media picked up on it fine, but mostly I believe it was a signal to the allies of Europe.
Yeah, and let's be clear about that word surprise. I think the visit itself was not a surprise. The timing was. The timing was a surprise. I think we expected at some point, perhaps around the anniversary, given that the president was heading to Poland, Tom, that perhaps he would make that visit.
The history here for America is really sensitive, John. This is about a country that always believes wars are going to be short, and we're always proven wrong. And, of course, we're coming off Afghanistan, which arguably was generations long. But, year two, there's a whole different tinge here. And 3 days we're to the anniversary.
I couldn't agree more. I think we framed it last week in the following way, Lisa, and I think this is probably an appropriate way to think about it from a financial markets perspective. It feels like the immediacy of this war has just faded, almost fallen off the radar because of the way the energy story has evolved over the last 12 months. This is not where people thought the energy market would be based on how long this war has gone on for.
Since we haven't seen a massive disruption in the energy market akin to some of the worst fears, is that really justification to say that the war has decelerated or somehow gotten more resolved? Because it hasn't. And that is really what's on the ground and what you're feeling. What we felt over the weekend is we heard that the U.S. was accusing China of potentially giving aid to Russia, and
or at least considering it.
Considering it, exactly, that they were considering this. What is the fear that could be another leg in escalation that really creates a new nature to this?
That's the ultimate fear, and I'm pleased Lisa brought that up, Tom. The fear is now that we could end up in some kind of proxy war between the United States and China. That would be something else.
Well, that would be a step further as well. And I'd also know Johnson and Truss in England lecturing on jets this weekend as well, just as a separate side story. Let's do this. Let's jump into this. And for those of you on radio, the image here with our Anne-Marie Horton, our chief Washington correspondent in Poland today is extraordinary. It is the most important image because, as you know, Anne-Marie, the justification of this, of Vladimir Putin, as Angela Stent told us in Putin's World, is he wants to go back before Stalin, back before Lenin, to some time of a Soviet view of the West. And that tower behind you in Warsaw says all, the Joseph Stalin Tower, that the leadership of Poland and the Polish people, they want to bring that tower down.
This is a very controversial clock tower in Warsaw and really reminds the Polish people of the hold of the Soviet Union had on Poland. And now, of course, the concerns of Russia and his invasion of Ukraine and the border Poland shares with Ukraine. This is a message that President Duda will bring to President Biden when they meet this morning. One, to make sure that security continues, potentially an ask for more U.S. soldiers on the ground in Poland. And it's not just about the security of these neighboring eastern countries of Ukraine because of the security concerns. It's also about the financial concerns. Duda, speaking to the Financial Times overnight, was talking about the fact that if there's not security in Poland, they are concerned about how their economy could withstand this. And they want to make sure this economy remains open for foreign direct investment. Means you have to have a secure country. So it's a pivotal moment for President Biden, not just because he's on the heels of this surprise cloak and daggers trip to Kiev, but also the fact that it is a signal to the Polish people and neighboring eastern flank about the fact that the U.S. is in this for the long haul.
Do you perceive in your reporting, Anne-Marie, that the distribution of any U.S. troops on the ground wouldn't be just troops in Germany from my youth, or even troops in Poland, but troops distributed from Helsinki down to Istanbul?
Well, what the president is going to be also doing while he's spending 2 days here on the ground in Poland is going to be meeting 9. So these are the Eastern Flank members, Eastern Europe, former Soviet Union members who joined NATO following the collapse of the Soviet Union. These are really important countries. They're countries that have been sounding the alarm for years about the concerns about Russia and Putin's potential wanting to amend the map, what Angela Stent has called for in a past. of how Putin's vision of his sphere of influence. But then, of course, Tom, yes, we're still waiting on go ahead from Turkey to bring in those Nordic countries to NATO, something that the president is definitely likely going to mention, that not just resilience of NATO in his speech this evening in Warsaw, but also the expansion of NATO under his leadership.
And Ray, Tom was mentioning the speech over in Britain about the potential for fighter jets. And we did see President Biden commit almost $500 million of additional aid to Ukraine. However, it was much of the same in terms of what the weapons were, what the ammunition, what the radar detection is. What's the next phase of support in terms of just material?
Right. This is fresh supplies, but not fresh new material in terms of what the United States is being willing to give to Ukraine. I mean, and there's been calls from Republican senators. Lindsey Graham over the weekend at the Munich Security Conference saying at least start training Ukrainian pilots on these fighter jets. And yesterday, while he had Biden's trip to Kiev and said it was the right thing to do, he wants the administration to take the next step and give them these fighter jets. When you talk to Ukrainians, they're always asking for more weapons. They obviously want these F-16s. That was immediately clear as well when Zelensky visited Washington. But there's also something else. The Ukrainians have changed in tone. And you heard this from Dmytro Kuleba, the Ukrainian foreign minister. And what he said is last year was about weapons, weapons, weapons. That was the message to the West. This year, it's about sustainability and speed of delivery. And this is how they think they're going to be able to make sure they can withstand a fresher Russian offense in the spring.
Anne-Marie, you've just gone through the needs of the Ukrainians abroad. Can we talk about the pressure at home? Some of the criticism coming from the other side is that the president is in Ukraine and not in Ohio. How's he balancing that?
Ohio. Yeah, this is coming from some members of the Republican Party, because you obviously saw in early February there was this train derailment in Ohio with toxic waste, incredibly devastating and concerning for individuals in Ohio. And what some members of Congress are saying is the president is in a foreign country giving more aid to Ukraine and is not visiting Americans in Ohio. At the moment, John, this is definitely a thread that we are tracking, and that is being picked up in U.S. media. And for these members of Congress, definitely something that they have concerns with the administration. But we should also say there are other Republicans who, like Mitch McConnell, like Lindsey Graham, they were at the Munich Security Conference telling the Biden administration that they want to see more aid going to Ukraine. And Mitch McConnell, the Senate Minority Leader, was talking about the fact that he thinks that the Republicans do not support the aid and the fight that the U.S. is taking on, and this unwavering support for Ukraine is greatly overshadowed. So there's a little bit of a dichotomy within the Republican Party back home, but certainly there's criticism towards the president for this trip.
AMH, wonderful to hear from you. Fantastic coverage, as always. Anne-Marie Hordern there. With the latest over in Poland, we'll hear from the president a little bit later on this morning, Tom. But ultimately, that's the balancing act for the president of the United States right now, TK. The pressure to deliver more to Ukraine and the pressure at home to do more here.
Yeah, I agree. It's a domestic and a foreign issue, but on the foreign issue, it's simple. Putin is speaking in Russia. I believe we've lost that feed. Maybe he's done speaking, John. But the bottom line is he reverts back to what we talked to Anne-Marie about. He's fighting for his, quote, historic lands. That takes us right back to 364 days ago.
Equity futures right now down 0.75% on the S&P 500. That conversation with the president coming up a little bit later, 11:30 Eastern Time. The President of the United States addressing the people of Poland, the people of Europe, and maybe even some of the pressure at home as well to deliver more. Futures negative. This is Bloomberg. Coming off the back of the first two-week loss on the S&P 500 of 2023 and taking some more weight off this rally year to date, we're down about 0.75% on S&P 500 futures. On the Nasdaq 100, negative 0.9%. This bond market is not helping out. 2s, 10s, 30s look a little something like this. Yields up again by 4 basis points. 4.66 on a 2-year, on a 10-year up 6 to 387.47. Blame Europe maybe this time around. The services data out of Europe, the Eurozone and the UK better than anticipated. This leading to a weaker euro. Believe it or not, euro dollar negative 1/3%, 106.55, teeing up higher rates at the Federal Reserve, at the ECB, and maybe even, Tom, the BOE. That data was pretty impressive today. And even the UK now, the conversation started to creep in. Perhaps they can avoid recession too.
It's fascinating to me, John, and I'm going to take it. I'm going to sound like a Michael Darter redux, but the bottom line here is I take it back to, okay, real growth is actually pretty good, but then overlay that substantial inflation, and that gives you a nominal GDP, which keeps the engine going, even if it's maybe not a healthy engine.
It keeps these central banks going too.
Oh, big time.
And that's ultimately the issue for people in markets.
Yeah. We're going to have to see. Right now, because of time, every second is precious, with Edward Morse, Global Head of Commodity Research at Citigroup, his public service to the nation a few years back. And, of course, Dr. Morse on hydrocarbons, on oil, on the global view. Ed, I have never seen from you a more indirect note. Edward Morse, stealing from Thatcher, says expect the unexpected. Define the unexpected out there along a burgeoning, reopening Pacific Rim.
Well, there are so many wildcards that are now abounding that it's really hard to know where to start. We can start with the China reopening, long anticipated, over anticipated. Now we're getting down to reality. The fact of the matter is that China may get back to where its oil demand growth was 2 years ago. China is on its way down. It's moving out of the world of oil consumption, and it's almost imminently there. After this recovery, I'd say it's the last hurrah for demand in China and close to the last hurrah for demand around the world. So that, for starters, is one of the things that's really impacting the market.
I look, Ed, at the dynamics here. Is it a study of supply or a study of demand? Which is most important to you and your Citigroup team?
I don't think we can separate them out at this moment. We're in a period of time when the world is definitively moving off of oil. We're coming out of a slowdown eventually, which will have a flash of oil demand. But it's really stunning to look at large countries. We look at the three major economies of the world. Europe's demand was down before the pandemic, and it's going to continue to go down. China's demand, if we look at major fuel uses, their demand for diesel peaked in 2015. They're coming back to a level that they're going to start retreating from. And indeed, we expect diesel demand in China to be lower this year than last year, and that's because of the surprise the world had with moving from natural gas, where prices were extraordinarily high, into diesel. And for China, that demand switch was between 300 and 500,000 barrels a day, and they're going back to natural gas now that prices have come back to earth. And then we look at the United States, and the stunning part of the U.S., at least in terms of weekly data, is that the U.S. demand is down below where it was a year ago. And U.S. exports are up significantly from where they were a year ago. The U.S., as a result partly of the release of strategic oil, but only partly because of it, has become by far the largest gross exporting country in the world. We're exporting close to 10 million barrels a day of oil, and that's after the SPR release was over. That's more than Russia. That's more than Saudi Arabia. It's more than both countries combined. And our supply is way up. If we look at real liquids, oil, biofuels, natural gas liquids, and the gains we get for running our refineries full out, we're a 21 million barrel a day producing country. That's kind of extraordinary, and nothing that we expected a year ago when this Russia-Ukraine conflict started and emerged.
So let's take a step back, because I'm curious how the Citigroup view of the world dramatically differs from the JP Morgan view of the next 10 years. Are you saying that demand is going down because of a lack of activity, a sort of more recessionary type of environment that perhaps the data points to, or is it because of renewable energy, because of electric vehicles, because of alternate uses that we've seen the transition really accelerate simply since the pandemic?
We actually have both going on. Yes, the transition is accelerating, and we can see that in electric vehicle sales, particularly in China, where it's 39% of all sales in 2022, phenomenal growth in Europe, and the U.S. is really not far behind. But it's also something happening in the trade environment. We've seen obstacles to trade being put in place, starting in the Trump administration in the United States, followed by what we call Bill CHIP, and IRA, the three extraordinary bills that were passed in the U.S. over a 1.5-year period of time, which really moves to block trade and bring a various set of things home, not home only to the U.S., because Buy America also includes some 20 free trade agreement countries. We have Europe that was moving in the same direction, and that started before Europe started mimicking the U.S. In trying to put forward something like the IRA bill. And we have China that, for energy and other security reasons, is pulling back from seaborne trade. So we have a retreat from trade that really started in 2017, 18, and it's been reinforced with various mechanisms. So we're not going to see, with this recovery, we're not going to see this greater pull on demand coming back with the recovery. So yes, it's a little bit of both.
So Ed, how come you're recommending to investors that they go into commodities? This is an attractive place to go.
It is an attractive place to go. And if we look at investments in the renewable side, they're blossoming. The issue is where to go, where is the greatest opportunity, and where is the greatest danger. But if we look at the numbers on the energy transition side, the world had gotten to around $850 billion worth of investment in 2021. And by the time we got through 2022, that investment turned out to be $1.1 trillion. And to compare that with oil capital spending, it peaked in 2014 at around $800 billion. So the opportunities are there. They're there in carbon capture. They're there in hydrogen. They're there in the areas where this new technology is working. That includes industry, it includes transportation, it includes buildings. So the opportunities for investors is really high, emphasized that by the tax credits given and the direct subsidies offered by major governments in the world.
Ed, this was wonderful to get your perspective, as always. Ed Morse there of Citigroup, and our apologies for that patchy connection as well. No apologies for this. Let's take a look at Home Depot. HD. We look like this. We're down by more than 3%. These are the numbers. So they're now forecasting flat sales growth, a decline in earnings, and they're going to have to spend $1 billion to increase hourly wages for sales staff in a tight labour market. We get Walmart at the top of the hour in about 22 minutes' time, Tom. I wonder if some of these themes come up in that report as well from that big retailer in just a moment.
Buried, I don't have it in front of me, but is the pricing power and unit growth study, which was not all that optimistic. And I really wonder if that's the theme here we're going to see is finally they can't raise prices. Is that PepsiCo did the same thing? Can they raise prices? Yes, it's been effortless. It appears, and maybe that's over. I've got a linear function out of the pandemic of Home Depot from 200 to 400. We come down into a zone, and right now here off of a 305, 306, 268 was at Home Depot level of the October angst that we had.
You've nailed it, Tom. Pricing power, tight labour markets, and it comes down to margins. What are they going to look like for the year ahead? That's Home Depot. We need to talk about Walmart in just a moment, Lisa.
And Walmart might be a cleaner read just simply because Home Depot is that much more connected to the housing market. So is there some sort of greater weakness there? That said, if you take a step back, this is an example of how Mike Wilson could potentially be right even if we don't get a recession. Basically, if you start to see real margin pressure, if you start to see a lot of these companies have to pay up to keep employees but not able to raise prices on the consumer that have seen their real wages go down so much over the past few years, all of a sudden you see margin pressure that could really create some weakness for stocks, even if the economy muddies along.
He doesn't think, Tom, these companies will be able to cut costs quickly enough to catch up with what he thinks is going to be a real earnings deceleration.
To his point, that's the shell game here. I'd also point out, is it a tech valuation? No. Home Depot giving you 19 times, 18 times earnings. It's not like a 25 stock, but nevertheless, it's had a heck of a run, but now runs into that margin angst as well. I look at EBITDA, 16%, is 16 cents on the dollar is pretty good. John, free cash flow pre-pandemic, 10, 11 billion. Now it's 16 billion. Not bad.
You see the latest take from Mislav Matejka over at JP Morgan on this equity market?
Please.
Here's the line from him. Historically, equities do not typically bottom before the Fed is advanced with cutting, and we never saw a low before the Fed has even stopped hiking. I'll share that with you again. This is basically what the bears are pointing out. Equities do not typically bottom before the Fed is advanced with cutting, and we never saw a low before the Fed has even stopped hiking. That from JP Morgan's Mislav Matejka. So Morgan Stanley's Mike Wilson is effectively saying that the Fed pivot pause is not coming. Mislav Matejka actually went one step further a little bit earlier this week when he said the following, and I think this is an important line. We could indeed see a Fed pivot, but even if we do, perhaps only it's in response to a much more problematic macro setup than what the market is currently looking forward to. So, Lisa, that's the pushback against, OK, even if we do get a pause, a pivot, rate cuts, you've got to think about why we would be getting them. And perhaps they wouldn't be for good reasons.
Right. If it's suddenly a rapid deceleration in the economy, it's not exactly going to be a phenomenal story for all risk assets. That said, if you start to look at what's getting priced in, people are not really looking for rate cuts this year. You're seeing a peak terminal Fed funds rate of 5.3% going down to 5.1% by December. So a much lesser kind of divergence from what the Fed keeps saying, and yet our stock's really getting the message.
You've got reading to do tomorrow afternoon. Do you know that, TK? Fed Minutes. Fed Minutes are coming out.
Oh, I thought it was
Highly
Formula One
anticipated.
racing. I'm studying.
Oh, are you?
Yeah, I am.
How far have you got in your study?
I'm fascinated by it. I still don't. I'm an American. I really don't get it. But at the same time, I get it. I mean, there's only 20 drivers.
What research did you do this weekend on Formula One?
I watched season 1 of the Netflix thing. I watched a special on Michael Schumacher.
Very cool.
And I mean, Mrs. Keene is like, what in God's name are you doing? All she can hear from the library is...
What a sound, though.
Vettel's sitting on my lap, scared.
It used to sound even better. They start testing this week.
I know. I'm ready.
And
I think we need.
Begins the following weekend.
Baku. I think I can see the three of us in Baku. Yeah.
Is that why you've taken an interest?
I know.
You've looked at the calendar.
Obviously.
I'm looking at it.
Beautiful places.
And my basic take is it's easy to go for Mercedes and Ferrari. We need to find the tots of Formula One. And I'm really, I could go either way.
Well, probably McLaren.
Ford's coming back, but maybe a McLaren, I think. Yeah.
Probably McLaren.
But, we could do a remote from McLaren.
You're going to be a McLaren fan, is that?
No, I haven't decided yet. I'm still studying. I'm like 4 years behind.
Okay. Futures negative 0.7. You decide in the commercial break. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Now, Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the New START nuclear weapons treaty with the U.S. China is now seeking to convince the world it's a neutral actor that can help end the war in Ukraine. That's coming a year after it declared a so-called no-limits partnership with Moscow. Chinese State Councilor Wang Yi is set to visit Russia after floating a fresh peace proposal to end the conflict. The U.S. has disparaged China's efforts. Shares of Credit Suisse hit a record intraday low. Reuters reported that Switzerland's financial regulator is reviewing comments made by the bank's chairman, Axel Lehmann, on outflows having stabilized. But results later show that outflows worth tens of billions of dollars continued. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Obviously, we had the outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Those comments attracting a ton of attention. That's the Credit Suisse chairman speaking to Bloomberg at the end of last year. And this is why it's attracting attention. The Swiss regulator, according to Reuters, Tom, reviewing those comments that the chairman made on outflows stabilising. That quote, they'd basically stopped, Tom. We've gone through the earnings results published this month showed that further outflows worth tens of billions of dollars continued until at least the end of the quarter. So attracting some regulatory scrutiny, according to Reuters, in the last 24 hours, and the stock attracting some selling. We're down by 6%, TK, 259.
Yeah,
Credit Suisse stock.
it's the way we're down, John. I mean, we're really coming down here hard. We came down to a 2.522. Yeah, we bounced up in the last 2 hours, John, but then we roll over here moments ago.
What does this company, this bank, want to be when it grows up? And how long have we been asking that question? 10 years? Still?
He's so rude because he's visited Zurich so many times.
Every time there's new leadership at this bank,
you're right.
It seems to me that they make blunder after blunder, error after error.
It's completely unfair, but John, I think you and I are on the same ground that from Brady Dugan on, it's sort of been a blur. I think is how
I remember sitting there with Brady more than 10 years ago.
You were our guy there.
Asking the same questions, Lisa, and we're asking the same ones now.
The problem is that they really have been supported by the wealth management side. And if people lose faith on the wealth management side, that's the issue, because we're dealing with a situation where what are the other ballasts of a bank that has really lost clout in a lot of the international banking sectors?
We are advantaged at Bloomberg. It helps to have journalists writing this up, as Jan Patrick Barnett is. But even better when he has tangible, real-world wealth management experience at OPCO and before that at a number of European banks. What's so important here, Jan Patrick, is you have actually sat across the table and watched assets go out the door. How does Credit Suisse staunch the flow of wealth management assets out the door?
So that's the big question, and I really struggle to answer that one because banking is a business of trust, and it looks like that Credit Suisse has lost all trust that there ever was. And the remarkable thing about the story right now is that there is no good outcome from it either. The bank's management was lying to investors, which is obviously bad, or if they were telling the truth. And outflows actually stopped, but then resumed shortly after, then it shows you that the management either doesn't know what's going on with the sentiment around their own bank, or they are unable to steer the bank in the right direction. So whatever the outcome from the story will be, whatever the regulator will conclude, it's bad for the bank either way.
And this is completely unfair, but with your experience, I think it is a bit of a fair question to take advantage of your years of doing this. Forget about the marketing, the branding, the cute phrases. Is it simple that wealth management assets will be sustained by the influence of Middle East big money saying, we own this bank, you've got to put your money into Credit Suisse?
Well, that can certainly help, I would say. But I mean, wealth management for Credit Suisse is more than just the Middle East. If they have a foot in the door there with their owners, that's certainly going to help to create some momentum in that area. But you also need Asia, you need Europe, you need the United States. And banking is a business of trust. And if you don't have that trust, you can do all you want with what your owners are saying. But when the individual people, investors, and the people who bank with you are not willing to do this, I have very little hope for Credit Suisse putting out a turnaround story that will be rather fast.
Jan Patrick, let's just talk a little bit longer about the regulatory scrutiny that this bank is attracting this morning and why. It wasn't just the comments, it was the timing. So the comments he made to Francine Lacroix that the outflows had basically stopped in December. We understand those remarks were made right before the closing of a $4 billion capital raise. Now, Jan Patrick, are we aware of the disclosures they made to the people who bought into that capital raise? Do we know if he told them exactly the same thing and that was what came directly from the bank?
So we don't know that, but the timing, as you point out, is horrible because it comes with a little bit, not just a little bit, with a really bad taste in your mouth that those comments come in the middle of a capital raise, which went okay. But then, of course, people now have the feeling that they maybe have been lied to or misled or whatever. Or even again, even if they were not lying or misleading, if they were just telling people what they were seeing, again, it shows you that you have a management in place that is unable to make a solid prediction, to tell people this is where we are and this is where it's going to be. And if you have that, I mean, how can you trust that bank either with your money in wealth management or with your money in the stock? I don't see it, and it's going on for quite a while now. And the cheaper the stock is going to be, the more trouble they will have to rebuild this trust. And we have seen this with European banks in the past. It can take years and years and years, and maybe another change in management. Who knows before you actually reach a bottom there?
Do they have years, Jan? If they are losing trust, if they are losing client money, if they are losing market share in other businesses?
It can take the bleeding can go on for quite a while. I would say. Like, I mean, at some point, Credit Suisse is so cheap now on paper. I mean, bank to book to price ratio is at 0.2 something. I mean, at some point there maybe is the idea of a takeover idea there. But I mean, like, why would you buy the bank right now? I mean, if the clients are coming to you anyway, so you don't need to buy them. So I don't see that happening. So it could well be, in my view, that the bank is just like not ceasing to exist, but becoming smaller and smaller and smaller over the years, and the bleeding will go on and go on and go on. Maybe not at the same pace as we're seeing it right now, but I think there's a realistic chance that Credit Suisse will never get out of this in the next 5 to 10 years.
Is this okay for the Swiss authorities? I mean, on one hand, you have regulatory scrutiny over misleading investors. On the other hand, is there a sense that they want to back a bank that is part of the national ethos?
Well, I don't think they don't want to do this. Of course, you want to make sure that there's a stable banking market in Europe, and you don't want to go Credit Suisse to cause any disruptions in the wider banking system. But I don't think that's going to happen. I think there's no issue of liquidity on the horizon. It's just like a constant decline of the bank going down, and this trust is like breaking away further and further and further, and the stock price is going down further and further. No drama, no crisis in banking here, and hence there is no real reason for the regulators to support the bank. They just can sit aside and watch, as can the management of Credit Suisse, and just watch the bleeding, and there's very little they can do unless they really have like come up with some strong message to rebuild this. But from the current management and the one before, we have not seen that, and there's no feeling of confidence from them into the lender.
There's a ton of bleeding this morning again and over the last year, that's for sure. Jan-Patrick Barnett, thank you, sir, of Bloomberg, breaking down the latest on Credit Suisse. The stock is down by 6%, another all-time low for the stock. We trade with a two-handle, have been for quite a while now, 260 in and around. And TK, it's up to them to come out with the relevant disclosures, I guess communicate with the regulator, and we'll talk about the outcome of this regulatory scrutiny. I'm sure they have some data, and we'll see if it backs up the chairman's comments.
I don't have the balance sheet in front of me, and I don't have the PowerPoint. And again, I said this earlier, I give them great credit for showing the balance sheet, the traditional banking balance sheet away from what Jan-Patrick was talking about, wealth management. But with equity down, I got a weighted average cost of capital, equity weight 4.5%. Debt, 95.5. Can we round that up to 96%? This is, I mean, the phrase, and I got to be careful here. In America, we'd say, is this a going concern? And I don't know if the Swiss are saying that, but what do you do at 2 francs 30? What do you do at 1 franc 98? That's sort of what I'm thinking.
I'll be slightly more diplomatic about it. I think it's described as the problem child of European banking in the same way, Lisa, that Deutsche Bank was many years ago.
The difference here is that it's not a liquidity risk. It isn't a systemic risk. So there's probably less incentive for some of the authorities to come in and step in and back the bank. And that's really the slow bleed that you're seeing in the shares. They are well capitalized. They're not about to necessarily be a systemic problem. And that's why perhaps they're not going to get bailed out in the same kind of way.
Do you further dilute people down to 2.20? I mean, it's...
Well, if they did another capital raise now, Tom, if they did, and we're just exploring this, if they did, and it turns out that the chairman's comments were incorrect,
I don't know.
How's that capital raise going to go next time around?
My arch question that I would ask regulatory experts is their behavior and the relationship to regulators. Would it be the same in London with FSA, or would it be the same in the United States with the Fed? And my answer is it wouldn't be.
Bottom line, Jan-Patrick, I think, put it correctly. It's eroding trust, ultimately. And the perception this morning is this erodes more trust, and it's up to Credit Suisse, and I'm sure they'll come out with their own comments on the matter in the not-too-distant future. Equity futures right now down 6 or 0.7% on the S&P 500. Fed minutes coming up tomorrow. Bit of economic data out of the United States in the 9 o'clock hour. So I think about 9:45 Eastern Time. Mike McKee's going to break down some PMIs. The PMIs out of Europe, better than expected. Yields higher across the board around the world, including in the Treasury market, up 6 basis points on a 10-year, 387.47. On this bond market, Nicola Mai of PIMCO coming up.
The market was priced for a soft landing, was very enthusiastic about a soft landing. And we had called this year a roadmap to recovery.
The likelihood of a soft landing, a garden variety recession, even maybe a small chance of a hard landing. That's all there.
Central banks now have to make a judgment on how persistent those upside surprises are going to be.
We're in the camp of a couple more rate hikes for the Fed, but not giving up on the disinflation story.
If the Fed really wants 2% inflation, they have massive amounts of work in front of them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Welcome back, everyone. After a long weekend, markets reopened. TK, welcome back to you as well, Bramo.
Thank you.
Futures negative 6 or 7 tenths of 1%, just starting, in a warm, nice fashion. Good morning to you all at home. For our audience worldwide, this is like smooth radio.
And I was about to say, what is this?
Jazz,
Smooth jazz. It's going to last. How long is it going to last?
The 9 p.m. Eastern Time edition, 10 p.m. late night kind of stuff. Smooth tunes, croaky voice. A few scotches with Tom, some
Did you
whiskey,
used to sit
cigar.
around and listen to Kenny G?
No, I didn't.
Did you?
No, I knew the Spyro-Gyro.
He plays the saxophone,
actually.
right?
But it's a little treble or tenor sax.
Okay, nice.
I knew the Spyro-Gyro people when Fusion
We
was
should get
breaking.
some music on the program and start with some sax.
I don't think it's going to be Kenny G. That's just my hunch.
The markets are open.
Good morning, Buffalo.
So let's get to that. Futures negative 7 tenths of 1% on the S&P. Yields are higher in Europe. This works. You want to keep the sound going? The music? Nice. Yields are higher off the back of better data in America. Lisa's going to go through the data a little bit later. We need to talk about earnings as well, Tom. We had Home Depot out a little bit earlier. Lisa, what have we got on the Walmart side of things?
So if you take a look, the adjusted EPS is expected to be about $1.25 versus that's better than expected to $1.30. You're also looking at an adjusted year earnings per share of $5.90 to $6.05. The expectation for the fourth quarter was $1.52. It came in $1.71, so beating across the board. I'm curious, though, to dig through the through the numbers to really understand whether you're seeing the same kind of margin pressures that you saw over at Home Depot. Are they raising wages and not able to pass that along to consumers?
Stock's up about 3% year to date coming into this, Tom. We're up 6 tenths of 1% to 1% higher off the back of this in a pre-market.
It's different than Home Depot, all the big, but Joe Feldman is great on this. It tells the advisory group, saying that every big box is different, Target's different. And what I see here, John, is a nominal GDP set of headlines. You've got an estimate of U.S. comparable store sales, ex-gasoline. To me, that's important. Nice beat, up 5%, is up 9% to round it up. And you really wonder what the forward vision is. Can they give us a nominal GDP forward vision or not, as we heard from Home Depot?
Stock now down about 2.5%. What have you got, Lisa?
I'm looking through this, and there is this potential opioid legal charge of $3.3 billion. They're also talking just in general about the situation. They're closing some of the inventories. They're lowering their inventory buys. Basically, fourth quarter inventory total went down 2.6%. I don't know that I'm finding some dramatic weakness here. It's just that clearly they're facing the same pressures globally you're facing, but I'll have to dig through the numbers to understand what people are seeing.
Well, stock's up by 1.7%. No real drama off the back of those numbers. Home Depot a bit softer through this morning as well. Margin pressure off the back of a bigger spend on labour costs. We'll pick up on that a little bit later. For the broader market, we look a little something like this on the S&P. We're down 0.75% on the S&P 500. The moves in the bond market, TK, let's be clear about that. Yields up again by 6 basis points. Your 10-year just short of 390.
Yeah, I'm going to look out 30 or 3.92 as well. And the inversion, I mean, it's dynamic right now. But I would go, as you say, John, to level of the core yields of a 4.66 and then out to a 10-year 3.88%. The 3.88 is different than 4.00, but we're moving there with rapidity.
The focus has got to be on Europe as well, waking up this morning. Lisa, bottom line, the data's better in Europe, and not just the Eurozone, but also the UK as well.
Okay, I'm going to drive you crazy, but bad news, good news is bad news in this particular situation. And the reason why is because you can imagine the ECB going further, which is all the more interesting that you're seeing dollar strength, because perhaps people think that it's all the more so in the U.S. Today, we're at the heart of retail earnings kicks off. We already talked about Home Depot, those shares lower. After it was clear that you're seeing margin pressures, Walmart just came out, and those shares are also lower. We're parsing through the numbers to try to understand why the year-over-year comparative sales without gas rose much more than expected. So how much, as we dig through the numbers, will this also be margin pressures? CPI year over year, you saw that come in hotter than expected. How much more are some of the consumers willing to absorb in terms of the costs that these companies are incurring? Then, of course, today we also have President Biden, who's going to be meeting with the Polish president. He's going to be speaking at 11:30 a.m. What does he say in terms of the scope of aid to Ukraine? I'm also curious whether he really talks about China and China's role. We heard that from Tony Blinken. Again, that was what stood out to me this weekend, this idea that the U.S. suspects China of thinking seriously about providing aid to Russia. And then following on with Europe, we did see better than expected services PMIs come out of Europe. What do we get from the U.S.? The S&P Global Manufacturing Services PMI for February coming out after we saw the biggest rise in Euro area business activity in 9 months. Do we see a similar kind of rebound, John?
Elisa, thank you. To focus on Europe in a big way in the last 24 hours, an unscheduled visit by the President of the United States to Kyiv, at the epicenter of a war breaking out in Europe, Tom. Just looking at live pictures coming through from the presidential palace, awaiting the arrival, Tom, of the US President, Joseph Biden. That's set to take place any moment now.
This is hugely symbolic, and it is the might of Poland. And I might also point out, John, and this goes back 30, 40 years, and with President Carter so ill, we go back to that era. It is not a small matter here that the Ukrainian and the Polish population in America, to use a scientific word, is truly ginormous. I mean, there is a domestic resonance here for any Democratic and Republican Party member as there is the international ramifications.
For anyone with one eye on the clock for this morning, so this is already about 15, 16 minutes later than scheduled, this arrival, Tom. We did have a scheduled bilateral meeting at 7:30 Eastern time, so about 24 minutes from now. That's probably going to get pushed back just a little bit. So we'll look out for headlines from that, and from headlines a little bit later on, as Lisa pointed out, 11:30 Eastern time, we get remarks from the president, at least we're scheduled to, on the one-year anniversary, Tom, of Vladimir Putin's invasion of Ukraine.
I know we've got to get to Nicole here, but this is so important. Robert Service, the esteemed Oxford historian, expert on Lenin, just put out a blistering tweet where he said, look, the Putin conversation sounded like Stalin in the 1930s. You think that's a big deal for us? Imagine what that's like for the Polish people.
But Tom, frame the contrast right now, and we can have that conversation with Nicola May. The contrast right now between the conversation Lisa just had with myself about the data in Europe, the economy's doing better, and what you're hearing from officials in Europe on what's taking place in Ukraine, which is just dreadful news. Nicola May joins us now from PIMCO. Nicola, the economy's better. The data's improving. Yields are pushing higher. And I think on both sides of the Atlantic, we're trying to work out how far these central banks are going to go. The ECB, the Federal Reserve. Nicola, based on where you were maybe 3 months ago, where are you now?
Yeah, I mean, I would say in Europe, the economic resilience has been surprising. Obviously, the huge fall in gas prices is a big factor. And, you know, China reopening is boosting sentiment. And there's a lot of pent-up orders that were built during the pandemic, which are being filled now. There's excess savings. Bottom line, I think we've skirted recession this winter. And I think recession was one of the key drivers of the disinflation that we were going to see ahead. And I think by now, with the economic resilience, we have to expect the disinflation to be slower than before. And as a result, the ECB going to 375 as a peak, which is where the market is priced now, is reasonable. But I would say there's a little bit of upside risk to that. You know, the hawks and the doves at the ECB have taken very differing views, but I would say the hawks at the moment, given the data, have the upper hand.
When I read the analyst notes over the weekend, people were talking about the potential vulnerability of U.S. credit as central banks around the world raise rates. But they talked about Europe performing better, even though credit spreads have contracted so much. Do you push back on this optimism about Europe in light of just how far the ECB is going to have to go?
Well, I would say that, I think for sure we should expect below potential growth, maybe a stagnant economy this year, partly because the monetary tightening will have an effect. It's possible that we'll go into a recession, but I would say the recession will most likely be mild because household and corporate balance sheets are pretty healthy and there's this cushion from excess savings and pent-up orders that I was saying. So I think you want to I think credit is okay, but definitely you want to stay in the investment grade space. You want to stay in the safer areas of the market. I think you want to be careful with high yield. You want to be careful with equities, partly because in the safer parts of the markets, you get juice that you didn't have until not long ago. So take risk, yes, but stay in the safe space because the monetary tightening has more impact to have.
I want to build on that, Nicola. I think you're making really important comments. I want to understand if there's credit risk in the sovereign and the perceived safety of sovereign debt in Europe. Maybe that's where the risk lies. Nicola, do you see an inflection point at some point? We've had an orderly pricing in sovereign debt markets of higher terminal rates, the prospect of stickier inflation as well. Is there an inflection point where things get to a certain level in Europe where we start to think about credit risk again?
Well, at these levels of yields, that sustainability in certain countries, including Italy, starts to be challenged. I would say, though, that compared to a few years ago, a few things have changed in Europe. First of all, significant fiscal integration via the Recovery Fund. Secondly, the ECB has shown that it is a lender of last resort for sovereigns when push comes to shove. And also, I think Euroscepticism more broadly has gone down as a political theme across the region. So as much as that sustainability becomes more of an issue, I think these factors are going to anchor the sovereign debt markets in a better way. So we could have a bit of a widening of sovereign spreads, but I wouldn't expect a crisis environment going forward.
Nicola Mai of PIMCO. Nicola, thank you. Always appreciate your thoughts, sir. Thank you very much on this fixed income market. Tom, I think that's the major risk, and I stress major risk, the ultimate tail risk, so to speak. If you're pushed into a situation of fiscal dominance, where the central bank has to come in and contain bond yields, even if inflation's going to be stickier, that's going to be the big call for real currency implosion in certain places. I don't think we're going there. I think we saw maybe a test case of that in the UK in September when cable dropped to 103.50 and the central bank had to step in and contain gilt yields because of what was happening with pension funds. That's going to be the big risk on the radar for a lot of people through the year ahead.
The big risk is to overlay all the central banks as one. They're dramatically different. I think the euro, we overestimate that the ECB is like the Fed. It's not.
Totally agree. Yeah. Totally agree. I've always said the major difference is that Chairman Powell doesn't have to look at what's happening with BTPs in the Italian bond market. Lucky him. Futures right now down 0.8%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the new START nuclear weapons treaty with the U.S. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. And Home Depot is forecasting a decline in full-year earnings. The outlook signals a slowdown in do-it-yourself spending at the home improvement retailer. Meanwhile, Home Depot is spending $1 billion to increase hourly wages in a tight labor market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The President of the United States has just arrived at the presidential palace, Tom, in Poland. That motorcade just pulling up just moments ago.
The history of this, John, is extraordinary in this moving from Ukraine over to Poland across that fractious border with Mr. Putin speaking in Moscow, and all I can think of is it's not that it's back to my youth, but the answer is we didn't imagine this 2 years ago, certainly before Crimea in 2013. I would focus, as the president meets the dignitaries, for those of you on Bloomberg Radio, it is a very traditional meeting. President Biden, no doubt, knowing many of these Polish authorities. And John, it's 700 miles north from Warsaw to Helsinki. And that's what this is really about.
Well, Tom, you said that this is a situation we couldn't imagine a couple of years ago.
Yeah.
I think for a lot of people, even 12 months ago when this war started, there was a real hope that we could move on quickly. And here we are, TK, 12 months later, still talking about this. And the kind of things that were red lines aren't red lines anymore. You remember only several months ago when it came to sending battle tanks to Ukraine, that was perceived by the administration and others, not only as unthinkable, but also an escalatory step. And here we are. And now we're not talking about tanks anymore, Tom. There are people having real discussions about sending jets.
For the international audience, and I think every nation's different, but there is a codified reality, and this is wrapped around the presidential birthdays of Lincoln and Washington, that a war that's appropriate in America is 4 years. We were weaned on that, John, and World War II was a little bit outside that for America. Let's call it edging on to 5 years. But the more recent wars have dragged on. There's a huge sensitivity now in America that a 1-year war becomes a normal 4-year war that comes outside that, as we've seen in recent efforts over the last decades.
Well, Tom, that comes down to the decisions of Vladimir Putin, the Russian leader.
Which was reaffirmed today.
And also a real worry within the administration that has come to light in the last couple of days, that they're concerned that the Chinese Communist Party, may well begin to contribute to that Russian war effort.
Yeah, to our people watching on TV and listening on radio, we have a wall of TVs in our studio here. We're really valued to have that. And I pretty much see Mr. Putin selling to the domestic media in Russia every single morning in his afternoon, John. And Putin's out there every day reaffirming his message, which to Poland has a different tone than to Washington.
The President of the United States, Tom, alongside his Polish counterpart, that bilateral meeting about to begin, we may well hear a couple of headlines from the President a little bit later this morning, Tom. 11:30 Eastern Time is when he's scheduled to make remarks about the 1-year anniversary of Vladimir Putin's invasion of the country.
This guy's different, with Anne-Marie Horton there. We're going to go to her, I believe, right now. Anne-Marie Horton, this president of Poland standing with the President of the United States, he has a true affinity to America.
Yes, he certainly does. Ahead of President Biden's trip, he was talking about the fact that he wanted the U.S. president here and welcomed him here because he says this is a show of force and a sign not just to the support of Ukraine, the country they obviously share a critical border with, but to the Polish people. This is a country that has welcomed so many of these refugees that had fled Ukraine in the wake of Putin's invasion. I mean, you look at the pre-war levels of the population of Ukraine, over 40 million people, about a third of them have fled. Poland has really been ground zero for that support, that refugee support, and it's the security concerns. And Poland wants to make sure the U.S. is ironclad with that security support. And as I mentioned in the last hour, not just because of the obvious security issues, but also because Poland wants to make sure it is a safe place for the economy and the business to thrive as they are dealing with this neighboring war.
I look, Anne-Marie, at the leadership of Poland. How are they distinctive from other Eastern European countries? What is the Polish distinction of the Budapest Nine?
Well, there's one clear distinction when you look at, say, Poland versus maybe Hungary, right? And that is that Poland has been very steadfast in the fact that they've been pushing the European Union to do more when it comes to sanctions. I mean, if you just look at the energy landscape, that has changed dramatically over the course of the past 12 months. This is something that Biden in March, when I was at his speech last year, talked about. He said one thing was crystal clear, and he wanted to make clear to Europe when he gave that speech. You have to end your dependence on Russian fossil fuels. Poland has ended a lot of it, but still 10% of their makeup of crude comes from Russia. And this is because of the Druzhba pipeline. Russian crude is still flowing into Europe. And regardless of some other Eastern European countries who say that that might be needed, Poland is willing to have these sanctions and end it for good. Their issue right now is with contracts. So they are out front really speaking heavily about the fact that they want to end all ties with Russia, while you see others potentially want to keep some business ties intact.
I keep wondering, what would Germany say? What would Germany do? Because this is really saying to Germany, increase some of the sanctions, increase some of the potential restraint on the Russian economy. And I was thinking over the weekend, what would Germany do if China took a more direct stance in helping Russia, as the U.S. administration is concerned about? How much pressure is there building on Germany to really take a harder and more public stance to support its allies, both in the U.S. as well as in Poland?
Well, I think the United States, and they've been talking to all their allies, whether it's the Munich Security Conference or behind the scenes, and obviously today and tomorrow in Poland, about what China is doing. And we just heard about an hour ago from Jens Stoltenberg, Secretary General of NATO, really repeating what Secretary of State Antony Blinken said over the weekend, which is that they see this non-lethal material support coming from Beijing to Russia. But what he told CBS News is that they are seeing concerns, potentially information, that Beijing is preparing to send lethal weapons to Russia. Now, this will be a difficult moment, not just for Germany, but for the world. While, of course, Russia and China are very close, I mean, this has been setting the stage, this friendship, for years. But obviously, last year, they decided to announce this no-limits friendship. But even years ago, 2018, Xi Jinping said, President Putin is one of my intimate, most best friends. At the same time, it's not lost on Beijing. The trade that Beijing has with Moscow dwarfs what they have with, say, the United States or Germany. But this is going to be a very difficult line for Beijing to walk, especially now that they are proposing this peace plan out in the front and the surface, but behind the scenes, they are still making sure they're keeping that communication open with Putin. And Xi Jinping has spoken to Putin 4 times since this war broken out. He has yet once called President Zelensky.
That said, Germany also depends greatly on flows with China, on trade with China. So on that side, how much cohesion is there among the Western allies to take a pretty hard line with this?
Well, I think what you're seeing right now is the hard lines are coming behind the scenes, right? I mean, this was also off of the acrimony between Beijing and Washington of the alleged Chinese spy balloon. So there's big tensions between Washington and Beijing. We also, though, had in the past few months, Olaf Scholz head to China. This is a difficult moment for these Western countries that are trying to potentially diversify out of China. All of their economic prospects, so much of it, is reliant on China. So I think behind the scenes, what you're going to be seeing is these meetings where they take a very tough line on China and try to make sure that Beijing does not step over that line that Secretary of State Antony Blinken was talking about over the weekend of sending that lethal support to Russia, because that would be a line that would be very difficult for the allies to ignore.
Do we have any idea on what congressional support for funding this war in Ukraine would look like, Anne-Marie, if there was a real risk of a proxy war with China?
Yeah, it's a great question, Jonathan. But as we've talked about for months, you'd be hard-pressed in Washington, D.C. to find anyone who does not want to take a hard stance on China. So I think what you can see there is that this would tip Congress into wanting to fund that support. I mean, what we've seen time and time again from Republicans and Democrats is they want more to be done in combating China and also sending more support and aid to Taiwan as well.
Anne-Marie, AMH in Poland. Anne-Marie, thank you for the coverage there. Tom, I think it's a very different question when we're not talking about the economy and we're talking about military action.
Oh, yeah, huge. There's no question about it. I'm looking at the feed here from Putin's speech, which I think has had less coverage today because of the pomp and circumstance of Warsaw. And it's interesting to see experts. I mentioned Robert Service earlier and other historians just saying the word that was used, one was alternate reality, is maybe what we're dealing with there. I think there should be more attention to what Mr. Putin said in his lengthy speech.
Well said. Equity futures right now down 8 or 0.9% on the S&P 500. Bond yields a little bit higher. Economic data in Europe better. US data still to come a little bit later this morning. Two-day losing streak on the S&P 500, 2 weeks of losses as well. A slight loss to mark last week. We're adding to those losses this morning. Good morning to you now. We're down by 0.8% on the S&P. On the Nasdaq, we're down by more than 1 full percentage point. Walmart, Home Depot not helping out that cause. Lisa will get to that in just a moment. In the bond market, we look like this. 2s, 10s, 30s, yields up 5 basis points at the front end. Having another look at 470 on a 2-year at 467. Having a look at 390 on a 10-year, up 7 basis points at 389, I guess we can call that. The focus on Europe so far, the data better. And it's not just the Eurozone, it's the UK as well. There is a real conversation about the UK avoiding recession. Europe avoiding recession. The ECB's got to do more. The Bank of England might have to do more. Euro dollar negative 1/3%. Lisa right here at 106.52.
And it is interesting, and you pointed this out, that there was better than expected services PMI data out of the euro region, and yet the euro is weakening versus the dollar. So either people are expecting it to be even better in the U.S., or the tightening cycle in the U.S. is going to be that much faster than people expected, and that delta between the euro tightening that much greater. So let's talk about the earnings that we've gotten. What they point to is margin pressure. What they point to is not being able to necessarily game out how to maneuver in what is a very uncertain macroeconomic environment. Home Depot shares lower by more than 4% after forecasting a decline in full-year earnings per share. They also are spending $1 billion on increasing hourly wages. Again, wages up, not being able to pass it all along to the consumer. Walmart, we've been parsing through. They actually had a disappointing view forward in terms of what their profit expectations are for 2024 and for parts of this year. But just to put this into perspective, Walmart saw the largest sales volume month in its history in December. This isn't a result of people not necessarily having demand. I want to read you just what the CFO is basically saying. There's a lot of unpredictability around what's happening. What will be the effect of Fed tightening on the consumer balance sheet? What is the effect of this declining savings rate? We feel good about how the core business is operating, John, but we're being cautious with the macroeconomic outlook. That's really the issue.
Well, I think they're right to be cautious. It's been very difficult as a retailer to understand these post-pandemic realities. They raced to get inventory. They got all the inventory at the wrong time. Then they had to get rid of the inventory, and we were talking about goods disinflation. That's happening at the same time the labour market's still tight. I mean, the margin story for a company like, say, Home Depot, that's the story this morning, isn't it?
It's all margin story. And how much do you get this really feeding into the Mike Wilson view of the world, which is basically you could get an economy that doesn't roll over while you also get margin pressure that causes a pretty significant issue for stocks. Meta, I wanted to talk about Facebook because they basically took a page from Twitter, and they're now going to charge for verification of certain users. And Elon Musk came out, of course, and basically said this is inevitable. But it just speaks to this new, more efficient, leaner, meaner machine that Meta, the Back to the Future.
Do you need a government ID to do that? I understand you might do.
I don't know all the details of it.
Are you willing to hand over those details to Zuck & Co. over at Meta?
Well, it's a good question, right? How much are people willing to give? Because in essence, there's a whole theory that we're already giving our data, and that's our payment to them for the service that they provide us. So now to pay on top of it, what more do you have to give over?
I get the verification importance. I think we're all on board with that. It's about how you go about it and whether you trust the end platform, Tom, with that kind of information. Do you?
The ambiguity now is off the chart. What I'm hearing consistently, John, through every theme, including Lisa's good conversation, is we don't know. I mean, that's just simply where we are, waiting for the John Ferro year entry March 31 outlook for the rest of the 9 months. Here, you're going to talk up Mr. Wilson here?
Yeah, it's been a tough couple of months for anyone who wasn't long equities and long tech leadership, to be specific. Mike Wilson and Morgan Stanley pushing back big time. He says the S&P 500 could slide 26% the first half of this year. And he said this: the bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. If you haven't managed to read the note that came out on Sunday, please do. It is a fantastic read, whatever your view on this market is. Tom, it's about climbing Everest and going into thin air, high altitude, and running out of oxygen and making poor decisions at high altitude.
Oh
Lisa, it's it was a fantastic read. I really enjoyed it.
I love the drama, the death rally or the death place or whatever he called this.
You're in
sense
the death
of
zone.
The death zone in terms of the evaluations with the equity rally becoming now the most expensive.
Some brutal stories about getting into the death zone, by the way, when you're mountain climbing. It is.
Oh, I thought you were talking Red Sox baseball.
No. We're talking about climbing and equity markets, apparently.
Don't they have oxygen? And if they run out of oxygen, they're
if you stop moving, it's like kind of over.
Game over?
Yeah, it's kind of over. I've heard some horrible stories about it.
Are you thinking of doing it?
No. I don't think I'm brave enough to go and do anything like that. But have you seen the pictures from Everest now that people are just in these long lines and they're just sort of, it's very strange.
The commercialization of
climbing Everest.
Yeah. Well,
yeah.
Tom, you want a road trip?
Tom's going to do Kilimanjaro.
We got a 6th floor walk up, so yeah, actually friends have done that, and it's harder, I think, than you think.
So I hear.
Kilimanjaro.
Yeah.
It's not like a rich kids suburban walls.
Well, I think that's what certain rich kids think it is.
Yeah.
Yeah.
Something
no,
like
I'm sure
that.
that's what it is.
We're going to get the wheels back on the track here right now, and we do it with someone with some real experience. I've really been looking forward to that. Linda Dissel is with Federated Hermes and senior equity strategist, but far more, when they sit around the table at Federated, including with the great Stephen Auth, they have a little bit of experience. I want to look, Linda, at the Auth-Dissel experience of over the decades, the simple idea that if rates go up, we're all going to die. How do I stay in the stock market if nominal and real rates go up?
Well, yeah, if rates go up, then, depending upon where you are in the bond market, you could lose money on bonds. We think that rates really have peaked out here, so we don't think that you need to worry about that so much. What you need to worry about is the debt that's going up. And we have had a lot of experience at Federated Hermes. Steve Auth and I know for sure, amongst others, we go back and we've been around since the 70s. And I keep likening this time period to the 1970s, where there is stubborn inflation, where you have maybe not a wage price spiral, but a wage price problem that's going to last longer than many people expect.
Mm-hmm.
Well, how does one advance through this? They should be defensive.
I mean, at your work at Carnegie Mellon, I mean, it's real simple here. You look at the x-axis, whether it's arithmetic or log. If it's going to be longer, how do corporations adjust, as we see with Walmart and Home Depot today? How do they adjust to the Linda Dissel world?
Well, it's interesting because profit margins are getting hit, but sales continue to go up, actually, and earnings are surprising to the upside. That's kind of what you see normally in an economic cycle. As the cycle gets stronger and people have more money to spend and they demand more of a pay, profit margins get hurt, but the bottom line actually goes up. So you can still make money in the stock market, but you're not at the front end of the economic cycle, on the back end, and that's when the Fed continues to raise rates. So we will agree that Fed is going to continue to raise rates. That's not the issue. The issue is how long will they stay up? How long will bond yields be up? And last week's CBO information came out from the Congressional Budget Office. We're going to have at least $22 trillion more in debt in the next 10 years than they thought just last May. So if you have a 3 to 5 year perspective, then you have to be sober in amongst all this FOMO activity that we're seeing.
So what's the distinction between the Linda Dissel caution versus the Mike Wilson death zone?
I think the death zone is really, it's a tough one to be calling. For this year in particular, the consumer is extremely strong. Companies' balance sheets are extremely strong. And all we're doing here and around the world is bouncing up and down around a zero level in GDP. The longer term is more, I think, of a malaise type question. I think we here in the US are going to be saved. Our day is going to be saved by the massive millennial and Gen Zs that are coming behind us, baby boomers, and they will be extremely productive. Our country's one of the best in the world for the long-term future, but we need to get our act under control here as far as the spending that's going on, or there will be a forced austerity by way of a weakening US dollar.
So how do you express caution but not Armageddon?
Well, you can express
Linda Dissel at Federated
Linda
Hermes.
froze. Linda froze
That's how you
over
do
the
it.
gloom of
That's how you do
Bramo.
it. Just to be clear, that's how you do it. You just say nothing. It felt like Bramo was asking for tips then. It's like, how do I express caution without coming across as conveying
Bramo goes all Armageddon there. Boom. That's it. That's in the control room. Ferro, you don't know, Lisa, but Ferro used to do that to me.
You would just freeze?
He'd hit the button so my mic would click off.
Just stop.
Seriously?
Well, we used to have a button in radio, yeah.
I remember the button.
Sure.
Yeah, well, it's sort of like kids when they were doing remote schooling and all of a sudden they pretend to freeze and there'd be a cat moving behind them.
Linda brings up a good point, which is not Armageddon, and it's not maybe Bramo gloom, but it's malaise. And is that the fear, John, that we just sort of malaise
flat market
through Q2, through Q3.
You think I'm going to make a call on this year?
That we go edge
based
of,
on the
based
on the first half of Q1 that we've just had?
Well, I'm just saying.
He's going to do it March 31st.
Lisa, don't you think malaise captures a middle ground between the surveillance death zone, the surveillance death zone, and the optimists that are out there?
Just to put some clarity on this. I'm not saying I'm calling for Armageddon or that I think that that's the case. What I'm looking at is a Mike Wilson view of the world, which sees a 26% decline to 3,000 on the S&P versus, what you see over at JP Morgan or even Bank of America. Michael Hartnett sees declines of 7%. That's a big distinction. So what is that distinction? Is it a leadership question? Is it the depth of some of the sort of earnings compression, the margin compression that people are expecting to see? That's really what I'm wondering. Linda Dissel was talking about the potential for people to keep spending in this robust economy. Well, they're spending, but they want deals. They're not necessarily looking. We saw that with Dana Telsey last week, Tom. She was coming out and she was saying, look, people are looking for deals. They're buying on sale. That's not going to be great for these margins.
I'm sorry, John, so much of this, and we're going to get this tomorrow. Edward Hyman pushes against this. I don't think there's never been an Ed Hyman death zone. Let's begin with that. He's a wonderful optimist on the American economic experiment. But I want to make clear, and we heard it from Ben Laidler, frankly, and John Stolfus has done one, not two. John's done 2 notes this morning calling this a baby bull market moments ago. There's a whole group there looking at this as the American innovation zone.
Short answer, all of the above, Felisa, all of the above. Coming into this year, we were hoping the disinflationary process had started. Chairman Powell said it had. It was about a question of whether that spreaded to services and how quickly that took place. Now we're having a conversation about whether it picks up again. And that's a real change from where we were just 2-3 months ago. And at the epicenter of that change was just the January data. So now you face down February and you're asking a question, okay, does February confirm January? Basically, and Mike Gapen of Bank of America was saying that if we get another big payrolls report, that's going to communicate to a lot of people that there was more signal than noise in the January economic data, and then we're going to have a completely different conversation again about terminal rates.
It's going to be a huge concern for the Fed. It would freak them out, I would argue.
I remember Bear Grylls. Do you remember Bear Grylls? He did a great after-dinner speech at Aberdeen at the Savoy Hotel more than a decade ago, when Aberdeen had the vows. That long ago. I was in tears as he started to describe getting to the death zone and losing a friend climbing Everest. I mean, it was heartbreaking. I was literally just sitting there at Aberdeen, just tears coming down my face, and then I think I ran out because I'm rock hard.
If they lost the bowels, John, you would have been
I mean, it was
tears.
seriously emotional. It was just amazing. Futures negative 0.8% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin is suspending Russia's observation of the new START treaty with the U.S. That's a blow to the last accord limiting their nuclear arsenals. In his State of the Nation address, Putin also warned the U.S. and its allies not to provide Ukraine with long-range missiles. China is now seeking to convince the world it's a neutral actor that can help end the war in Ukraine. That's coming a year after it declared a so-called no-limits partnership with Moscow. Chinese State Councilor Wang Yi is set to visit Russia after floating a fresh peace proposal to end the conflict. The U.S. has disparaged China's efforts. In the euro area, business activity rose at the fastest rate in 9 months in February. That's raising the likelihood that the bloc can avoid a downturn this quarter. Both France and Germany returned to growth after likely pullbacks in January. Shares of Credit Suisse hit a record intraday low. Reuters reported that Switzerland's financial regulator is reviewing comments made by the bank's chairman, Axel Lehmann, on outflows having stabilized. But results later show that outflows were tens of billions of dollars continued. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Some higher inflation numbers for January. I don't necessarily think that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome.
Jan Hatzius there, the chief economist at Goldman Sachs, looking for a higher terminal rate in the last week. That move from him coming after better data in America. CPI and retail sales. CPI last week feels like a month ago. I mean, it really does. Welcome back after a long weekend stateside. Equity futures look a little something like this. Equity futures on the S&P, negative 0.75%. The earnings this morning not helping out the equity bulls, that's for sure. Home Depot a little bit earlier. They went first at 6 a.m. Eastern time. They forecast a decline in full-year earnings per share. And an extra spend on the labour story, increasing hourly wages for sales staff and a tight labour market. That's going to cost them $1 billion. That stock's negative. Home Depot down by 3.9%. Then Lisa, Walmart out about 50 minutes or so ago. Initially, first blush, first read seemed okay. Bit of a pop higher, and then reality strikes. Walmart down by about 4%. Talk to me about that reality.
Fourth quarter, fantastic, beat expectations. The biggest sales volume month in December in Walmart's history. And then the projections forward. A disappointment in 2023, a disappointment in 2024, with the CFO saying, we feel good about how the core business is operating, but we're being cautious with the macroeconomic outlook. How much do we continue to hear this? And what is that macroeconomic outlook? Is it consumers pushing back on some of the price increases, or is it actually a deceleration in purchases because of the savings coming down?
Lisa, you sent me the quote from the CFO. Tom, there's a lot of unpredictability around what's happening. I mean, yeah, that's for sure. The stock's down 4%.
Well, it's down 4%, but I'd say they're within a zone here. And the question is, do they come down to the support that was seen in October? This is something we love to do at Bloomberg Surveillance, and that is talk to securities analysts with esteemed experience. She goes back to Lehman. Karen Short joins us now with Credit Suisse. To say she's an analyst barely describes the trophies on the mantelpiece, including the very challenging Starmine Awards. Karen Short, thank you so much for joining us today. I want to start at the top of the income statement. When you look at unit and price dynamics at big retail, what do they look like?
Hi, thanks very much for having me. Well, I mean, I think, as you said, Walmart, this is one of Walmart's better quarters on top line. The issue is flow through, really, on bottom line. And then that translates into the implied guide for the P&L for calendar 23. I mean, I think, we have two of the big box retailers out there today, this morning, Home Depot and Walmart, slightly different tales on retail. Walmart's clearly seeing trading in, but Walmart's clearly also seeing a higher cost to serve, as is Home Depot. And that's the biggest question is these essential retailers that have all benefited for the last 3 years. What is the sustainability on the P&L on actual operating profit margins relative to top line growth that they've gained and sustained? And it just appears that it's a higher cost to serve.
Do they use traditional retail management practices to adapt and adjust, say, into the back-to-school holiday season? Or can Karen Short say this time is different for big box retail?
I personally think this time is different for big box retail from the perspective that, we were very neutral on almost our entire coverage universe when we initiated in December. And I think the issue is that some investors believe that the top line just will naturally flow through to a higher margin structure. And I don't think that's the case. I think the problem that retailers are going to face is that it's just a higher cost to serve, and margin structure may be just very similar to pre-pandemic levels on a much higher sales base because costs keep flowing through. And case in point, Walmart called it out obviously earlier prior to reporting on labor, and Home Depot did today in terms of their $1 billion investment in labor. Cost to serve is just going up, and margin structures may not be any better structurally than they were pre-pandemic, despite 20, 30, 40% sales improvements per box, depending on which retailer you're talking about.
Is this a story that really goes across the retail sector? Are you basically seeing the same margin pressures in Walmart and Home Depot, or is it more in Home Depot, less in Walmart? Do you expect it to not necessarily be consistent throughout the retail complex?
I don't think it's consistent. I think what you really have to look at is some retailers really leaned into investing during their sales gains. So Tractor Supply, for example, really leaned in and did not flow through margins. They invested, and their margin structure hasn't really changed. And I'm talking about operating margins when I say margin. Didn't change much, even with a much higher sales base. Other retailers, and I'm not saying this about Walmart and Home Depot necessarily, but other retailers definitely harvested. And I think what's catching up to many retailers is you should never harvest your sales gains. You always have to reinvest. And the better retailers have reinvested. I mean, Walmart clearly has reinvested in wages. They announced that several weeks ago. Home Depot just announced another wage investment, but I think retail investors are going to be shocked by the fact that that those massive margin increases across much of retail are just going to be completely imploded and probably even be down relative to pre-pandemic levels because costs to do business have gone up. And sales are, maybe higher, maybe not, depending on the retailer.
Well, Karen, let's talk about that. So the cost to serve is going up. Got it. Margin structures won't be any better than pre-pandemic. Got it. They might be worse. Got it. Let's just lean on something else you said. Whether it's coming off a bigger or smaller revenue base. Karen, what are the retailers you think are out there that can offset some of that margin pressure with just better top-line growth?
I mean, obviously, so my coverage is essential retail. So it's, I can't comment across much more discretionary. But within my coverage, I mean, I would say that the club stores, so like if you take a Costco and a BJ's, their deleverage and or leverage points are so much lower because their fixed costs are so much lower. So like a Costco and a BJ probably has more ability to retain margin improvement. But the rest of the retailers, I think you have another investment cycle coming. I mean, I think you have that for the dollar stores. Obviously, we just heard from Walmart and Home Depot that they will have that. I mean, I think you'll probably hear that from Target. I think you could hear that from Best Buy. I just think across the board, there is another investment cycle coming. And I don't think that you could I don't think I could point to many retail names that I cover that will have up EBIT or up EPS, even if sales are flat to slightly up.
Karen, this was amazing to catch up with you. Thank you. Karen Short there of Credit Suisse.
Thanks so much.
Just a snapshot of retail and the epicenter of it, that line that popped up a couple of times in that conversation, Lisa. The cost to serve is going up. The cost to serve is going up.
We're seeing that with wages. We're seeing that with all the potential back-end aspects, whether it's delivery and the trucking and whatever else. She also said there's another investment cycle coming. And this is sort of the clash here of the economy and the market. On the economic level, everyone was asking companies to invest more, to pay more. And suddenly that's going to fuel more spending power and more momentum on the consumer side. On the flip side, it's going to perhaps be at the expense of margins. And so at that point, can you see a negativity for a market story while it's a positive for the economy?
You're right to make that distinction. I think it's the important one. I was thinking of the same thing at the same time, Lisa. Tom, this is the story. If you're President Biden, you probably like what you just heard.
100%.
If you're long the equity market, you probably weren't too thrilled about it. And I'm sure that at this point, the president cares more about that than he does about what people long the equity market, Tom, are thinking about.
Can we see beyond whatever the outcome as inflation is to some kind of new normality of 3% or dare I say 2% inflation? If we get the rate structure down, maybe we don't get back to what we knew in 2019, but we get to something new, sort of kind of like 2019. How does retail adapt? They've adapted every single cycle.
You need a labour market economist to answer some of these questions for these retailers right now. The cost to serve's going up. Why? Because they think the labour market's really tight. Do you think that loosens anytime soon?
Doesn't seem like it.
3.4%?
I mean, not from what we're watching. And if you take a look at real wages, they've been pretty deeply negative for a number of years since the pandemic, not just in the U.S., but around the world. So there's still catch-up. If there's a tight labor market, people will demand more just to keep up their quality of life.
There's different parts of the labor market. There's, somebody had a great headline out that it's a rich session. I saw that this weekend. Somebody had it in New York Times or whatever. But every single partition's different.
Some people out there are so brutal. I've just got this email. Karen Short at Credit Suisse. Can you find Karen Long, please? Isn't that great?
That is.
I'm sure that's not the first time she's heard that joke.
No.
All right? Futures negative 0.75% on the S&P. This is Bloomberg.
The conversation is shifting. Are we actually getting a re-acceleration instead of a slowdown at all?
I think it's going to be a year where we frustrate both the bulls and the bears.
This is a very uneven recovery.
Focus on quality. Focus on the companies that can manage margins. The story of the year is wages.
I'm a FOMO guy. I don't want to miss out on what will ultimately be a nice recovery in these markets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Welcome to a Tuesday, a 4-day work week around the gloom, the death zone that we are all in, and maybe the optimism forward. Edward Hyman with us tomorrow. He'll bring us some optimism, no doubt. But what we've got now, it's a toxic stew, John, that I've heard for the last 2 hours.
That's a new one. Adding to that toxic stew or brew, whatever you want to say, Mike Wilson of Morgan Stanley thinks we're at that so-called death zone. There's no oxygen up here. This equity market's going low with the Fed pause pivot's not coming.
Kind of makes for good
Heard from
TV,
Mislav Matejka of
radio.
JP Morgan that said even if the Fed pivot did come, it'd probably be because the data's bad, and that's not a reason to buy either. Bottom line this morning, data's good. Yields are up, data's better in Europe.
And life goes on, and I really heard that from Linda Dissel. I mean, the basic idea, you know, she mentioned malaise. It got picked up on Twitter a little bit, the Dissel malaise. We just, there's a huge uncertainty from the death zone to the optimism of the Uber bulls to the malaise of the moment.
Lisa nailed it as she always does, Tom. There's a difference between a better economy than expected and a decent equity market. And picking up on that story, the perfect case study for that conversation this morning, Lisa, is what's happening with Walmart and Home Depot.
I couldn't agree more. Their sales did phenomenally, in some ways recording better than expected sales numbers on an absolute nominal basis. But the margins, not there. Expected to see more margin compression going forward. How much does this really shape the narrative? They cannot pass along the costs of the investment they have to do to keep workers and to keep investing in their infrastructure.
I'm looking at the whole thing, and it's a drama. Of course, we saw this with President Biden in Poland this morning as well. I think underplayed here, and John, you mentioned this earlier, the better tone out of Europe, the move forward with great uncertainty, and the maximum uncertainty this morning came from Mr. Putin in Moscow in his lengthy speech. That's been underreported today, and how that affects the earnings and financial tone.
Yeah, we've got to talk about the economic data too. Just a scheduling note, I guess. No payrolls Friday, next Friday. It comes on March 10th.
Way late.
I believe.
Yeah,
so a little bit later than anticipated.
Late.
If you want a source for volatility in the next 24 hours, maybe it's the Fed minutes. And I wouldn't typically say that. They come out at 2 p.m. Eastern time tomorrow, Tom. Is this going to be a platform for the doves or the hawks? If you'd asked me that at the last news conference when Chairman Powell said, look to the minutes, I would have said maybe that's a platform for the doves, because that was in response to a question about a Fed pause. And now you've heard from Bullard and Mester, non-voters but are heard in the meeting, talking about the prospect of 50. So does that come up? Does the conversation about financial conditions come up?
Listen to you.
Because in the news conference, he's meant to represent the consensus on the committee, and let's hope there is one, for him to communicate for his sake. But does that come up in the minutes in the same way it did in the news conference, Lisa? Because in the news conference, he basically didn't really push back at all.
No, but he did say, read the minutes, basically saying this is where we'll outline what we really think. How much do they massage the minutes to have a different message
here we go.
than they would have had? No, because they can really give some guidance through the way that they characterize the discussion. I'm serious.
Me.
Well, okay, on one hand...
Post-meeting massaging of the meeting.
Well, it's just to sort of give a message that perhaps is more hawkish than how he came off, because they can give a different tone if they see the facts as somewhat different now than they were then.
You think that Chairman Powell turned around and said, redact that.
I'm not suggesting that they're going to lie or anything.
We'll ask Mike McKee.
But they can emphasize certain points more than others based on how they see the market, how they see the conditions. This is part of their communication strategy.
I think you're way overanalyzed. I'd go to Hatzius and what he said to Bloomberg.
It's literally an
You're
entire
25. My question is, I promised you I'll read the minutes, but John, do I read the minutes or do I watch Leipzig Man City?
The big games later, Tom. Liverpool, Real Madrid.
This is a huge deal.
That's a proper match.
What is it like to have one of the great European teams visit, a great stadium of Premier League?
Like Anfield.
What's it like? What's
Anfield
like?
is a very special stadium, and a stadium that a lot of people fear, particularly at the beginning. You know, they all sing that song at the beginning in Anfield. Real emotional stuff. Teams don't like going there. They don't like going there. And I think that becomes quite psychological for the visiting team. Okay. They convince themselves that it's not a great place to go, and then they underperform, but they don't like going there at all. For that matter, Tom, I wouldn't like going back to the Bernabeu to play the return leg either at Real Madrid. So it's going to be fascinating to watch that. That's a repeat of the final from last season.
Yeah, well, we'll have to see. Our guest here is of value. Lee Farage has a lot of experience, and John, he's riveted on Liverpool today. I mean, just to see what they do. But why don't you bring him in? What I love about it, he's looking at this year as an anomaly, and I think that's really interesting.
Well, let's talk about that. Lee Farage joins us now, the multi-asset strategy head over at State Street. Lee, why are you looking at this year as what Tom called an anomaly?
Well, I think it's going to be, it's going to be an unusual year. And I think the market's starting to get to grips after the payrolls number and the retail sales and the CPI. The economy is going to stay strong in the first half of this year, probably into Q3. You know, the consumer in the US is still in a good place. Everyone's still recession talk, soft landing, et cetera, et cetera. But the point is that US consumers are not really being hurt by higher rates. We have 91% of mortgages that are 30-year fixed, right? So in other countries, as rates go up, that hurts the consumer straight away. What we're seeing coming through on the data here, it's not happening here, particularly when you have such a strong labor market. And this is a real problem for the Fed.
Well, I mean, Lee, what's so important here is then how do we participate in the stock market? Whether you're doing it through index funds or active management or individual stock selection, how do you participate given the death zone that is either here or out there somewhere?
Quite honestly, Tom, right now, I wouldn't participate. I mean, that's, you know, my view is that you know, I would agree. I think stocks have got ahead of themselves. I think they priced in that sort of that Goldilocks soft landing. Fed are nearly done. We're cutting in the second half of the year. It's nonsense. We're not. Right, so the Fed is going to keep going. I agree. I think they'll go through to June, maybe even July. Can't be ruled out. So no, I wouldn't be participating in stocks right now. I think we've had what I think was a significant bear market rally. I would not rule out a return back to the lows.
Wow. Lee, this is an agreement that, or an idea that a lot of people can get behind. One thing, though, that you do say that is a bit counter consensus is that you think the dollar could strengthen considerably from here. How much of a pain trade could that be, considering that everybody said Europe was the place to be this year?
It could be a significant pain trade. I mean, I think, look, you know, as I said, you know, 91% US mortgages are fixed rate. That is not true in Europe. It's not true in the UK. It's not true anywhere else. So while others fall by the wayside as consumers take the hit from higher mortgage payments, higher debt payments, and we see weak data elsewhere, I really think you're going to see separation in the US, and it's that will drive the dollar higher. So it is going to be a pain trade. Look, back in October, we saw a massive overweight in the dollar. Looking at our indicators now, the overweight in the dollar is about a third of what it was in October for institutional investors. So that means there's potential to rebuild those dollar longs. And as you say, it's a huge consensus to be negative the dollar now. I think that's going to be really, really painful over the next 6 months. I think we will see the DXY rally back, maybe not to the highs we were at, but I can see the euro back in the low, you know, 101, 102, sterling back below 110. I think that is perfectly feasible in the next 6 months.
Does that make U.S. assets more attractive than, say, in Europe or even emerging markets? In other words, is this going to be a reversal of the entirety of the first month of this year?
I think it is. EM is another area where everyone's been desperate to buy EM. And like selling the dollar, at some point that will be a great trade. Buying EM at some point will be a great trade. But everyone's gone in very, very prematurely on the basis of that Goldilocks scenario, which is starting to unravel, but people are still maybe January was a one-off, maybe the weak data's coming. Well, if it doesn't, then all those people piling into EM are going to get hurt, I think. So, look, at some point, EM's going to be a great trade. It's just not yet.
Elite, that number, 90%. Are paying fixed rate mortgages, and the duration of them, Lee, is so much longer than what we see in the UK and Europe. I mean, UK fixed, Lee, we're talking what, 2 to 5 years, something like that?
At most.
We're talking about fixed here that are going for decades, Lee, and I just wonder, what are the consequences of that? Just a generation of people locked into a mortgage, they're just not going to move, are they?
No, I mean, it does mean that people don't move. But what it means is the Fed's job is that much harder. Even if you look back to the early 80s, the last time we had, the inflation issues we've got now, only around 50% of mortgages were 30-year fixed back then. The rest were sort of arms or floating. Now you've got 91%. And not only that, a lot of people refinanced during the pandemic at much lower rates. So if you look at mortgage servicing, debt servicing costs, they are lower now than they were before the pandemic. So even with rates where they are, even after 450 basis points of hikes, mortgage debt payments are lower than they were pre-pandemic.
So, Lee, when they say long and variable lags, do they mean like decade-long variable lags?
Well, this is the thing about the long and variable lags. The lag or the impact is going to be much more drawn out because you're not hurting the majority of people. So you hurt new activity, new home sales, new car sales, etc. But if you have your house, you have your car, all on fixed rates, nothing changes.
Hey, Lee,
and that means
great.
It takes a long time.
Super smart, as always. Lee Ferridge there.
I've never heard him this gloomy. Is he this gloomy because Liverpool's in 8th?
They're not doing well this year.
Yeah.
Do you want a prediction, Lee? Is Lee still there? Do you want a prediction, Lee, on Liverpool Real?
I think we're going to win 2-0.
2-0.
So specific.
At home.
See that he talks
what about the return leg? Is that including the return leg?
No, the return leg's going to be 1-1, so we will go through.
Okay, you advance. Good to know. All right. No bias here whatsoever.
Always trusted
Is that
Jurgen.
a red sticky?
It's a red headline.
Ferridge.
It's going to cross the Bloomberg in a moment. Lee, thank you, mate. Lee Ferridge there, State Street. On Liverpool, Real Madrid a little bit later. And, of course, on this market. Those long and variable logs sound pretty long, don't they?
Don't get me going. This is out of Chicago years ago. I've always had trouble with it. What I would suggest there, I've never heard Mr. Ferridge that cautious, ever. I've never heard Lee Ferridge that cautious.
Getting gloomier.
Yeah.
The higher this market gets. What did Lisa say earlier? Can you help me understand how you communicate the difference between, skepticism and Armageddon? Was that it? No, it's not. Caution and Armageddon, of course.
Well, I mean,
thanks for the clarification.
Been the notes. That's been the tenor of the notes. I'm not saying it. It's just,
not at all.
The death zone.
Down 8 cents on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin is suspending Russia's observation of the New START treaty with the U.S. That's a blow to the last accord limiting their nuclear arsenals. In his State of the Nation address, Putin also warned the U.S. and its allies not to provide Ukraine with long-range missiles. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. Walmart came out with a profit forecast this year that fell short of estimates. That signals a cautious outlook for the world's largest retailer after last year's performance was hurt by a surge in inventory. Walmart says earnings will fall by as much as 6.2% in the current fiscal year. And Home Depot is forecasting a decline in full-year earnings. The outlook signals a slowdown in do-it-yourself spending at the home improvement retailer. Meanwhile, Home Depot is spending $1 billion to increase hourly wages in a tight labor market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, you need a higher stable inflation rate, call it 3 to 4%.
Fascinating to hear those comments from Mohammed. It was great to catch up with him on Friday. Mohammed Al-Arian there, the Allianz chief economic advisor and Bloomberg opinion columnist, amongst other things as well. The story here, essentially, is that he believes the least worst option now that the Federal Reserve can take is just accept a higher inflation rate. Not because he thinks that's good, he thinks that's bad. He just thinks the alternative idea is even worse. Ultimately, you'd have to crush the economy to get down to 2.
It was a terrific interview, and I listened to it very carefully because he doesn't think it's a good idea to raise the inflation bogey, but there isn't necessarily a better option. And this really goes in the Adam Posen line of thought. Do they telegraph that, though, or is it just sort of accepted and they become more dovish? I'm talking about the Federal Reserve, as they see inflation come down, but maybe even not as much as they'd like.
Because they were so late, and he warned about it so many times. He also said that at the last meeting they should go 50. But they'll go 25, and the recent economic data subsequently maybe speaks to the idea that perhaps they should have.
You're starting to hear, though, more people, even people who thought of a softish landing and thought that there was this really significant disinflationary force like Jan Hatzius over at Goldman Sachs, start calling for potentially 75 basis points more of rate hikes or even another 50 basis point hike at one of the upcoming meetings.
Important. He echoed Greenspan in a measured way. And measured is different than the emotion of the jump conditions that are out there right now.
January changed the conversation. The economic data from January that we've witnessed in the last couple of weeks in February. We've said this a few times, Tom. We have the luxury of saying this. It's too early to draw conclusions. If you're in this market, you probably don't have that luxury. But we have to wait to see if February confirms what we saw in January. And March, for that matter, and April and May.
We'll have to see. Right now, just quickly a note from the wonderful Oliver Chen over at Cowen. He reaffirms an outperform on Walmart. His full note will be out here in a moment. This is a joy and is incredibly well-timed. He is with the Bank of England, or was with the Bank of England, and we're not going to ask him if the Bank of England is declaring victory. But Spencer Dale has a unique portfolio to bring to us today. It is not only his work in economics at Wales, in Warwick or Warwick? Help me here. Warwick. Thank you. Good. It's good to know that. But Spencer Dale also here with his work with the British Petroleum Group. Lord Brown has been someone that supported our economics for years, and we're thrilled that we can dovetail in what BP sees out there in energy with the heritage of British petroleum. I thought Oswald Clint at Bernstein was great on the day where BP said we're going to have to walk away from all that we did on Russia. How big is the turmoil right now in global oil like a year ago when BP said we've got to walk away from Russia?
I think that the oil market remains very uncertain, but I think the biggest surprise over the last year is Russian exports of crude haven't changed. You look now compared to a year ago, they're pretty much unaffected. Where they're being exported to has changed very dramatically. A lot of it was going to Europe, and you've seen an almost massive shift away from Europe now, particularly with the ban, into India in particular and China. But overall flows of Russian oil pretty much unaffected.
Everybody has to lean forward when BP studies this, and you do this within your annual survey as well. What is the distinction we have to know about Mr. Putin and the cash coming in from his oil sales?
So I think we spent quite a long time thinking about how the war may affect energy markets. And I think the simplest way I think about this, if you sat in the ballroom of BP or in government officials around the world a year or two ago, all the conversation was about the importance of decarbonising the energy system, the race to get to net zero. That urgency stays, but the war has been a sort of collective reminder about the other things energy systems need to generate. So they need to give us energy security, and they also need to give us energy affordability. You put those three things together, so energy economists will often talk about security, affordability, and sustainability as the energy trilemma. You can't solve a trilemma, but the importance of the trilemma is you need to balance all three of those different elements if you're going to have a successful and enduring transition. And I think there was a danger that prior to the war, the world had come focusing on just one element and had lost touch on those other two.
We heard from Ed Morse of Citigroup earlier today, and he was talking about a pretty radical view that Chinese and global oil demand may be close to its peak and is probably on its way down because of the trilemma and how different economies are trying to solve it with other forms of energy. Do you agree?
So I guess two things about China. One is In the near term, everybody's been surprised by just the pace at which China's relaxation of the COVID policy has happened, and so have revised up their views of oil demand growth this year. So a story, if you look at most people now, consensus out there would have oil demand growth of about 2 million barrels a day this year. Of that, around half of that is China. So they're massively important in the near term. The story, which I guess relates to Ed's piece, is when you think about energy security, countries worrying more and more about energy security, a natural instinct will be to say, I want to reduce my level of imports I'm making of energy, and instead boost my domestic energy. And the nature of that is most domestic energy from many parts of the world, including in China, is non-fossil fuels. It's wind, it's solar, it's nuclear, it's hydro. Most of the energy that you import around the world, particularly in China, is oil and gas. And so one of the stories that we have in our outlook is we think the war is likely to accelerate the energy transition because of this energy security effect. Import less oil and gas, boost your domestic renewables, and that has a positive in terms of the energy transition.
It's such an important point when people look at commodities as almost a proxy for global growth. If the economy does well, supposedly oil prices should go up. If the economy goes into recession, oil prices should go down. Are you getting on board with the idea that oil prices can stay low even with a decent global economy because of all of these alternative forms of energy?
So I think one is those alternative forms of energy. We've also seen a key factor which I think helps to balance markets is what's happening here in America in terms of US tight oil, US shale oil, and the nature of those businesses. And at one point, they were able to sort of act as a moderating influence on oil prices. I think the nature of those business models, you guys I'm sure have talked about it a long time, has changed now. Far more focus on giving returns back to shareholders, reinvesting less. And as a result of which, I think that's caused the price at which those rigs start to come on to be higher now than it was a year or two ago.
Spencer, where does coal consumption fit in here, particularly in Europe?
So I think coal consumption in the very near term has gone up, essentially as you've been scrambling around for resources. But further out, I think we're seeing a story in Europe of a mass movement away from that coal, and seen very significant reductions in sort of coal-fired power generations in the UK, in Europe, and I think that trend I don't think is going to go away.
There's three factors behind Europe's better performance. That's consuming less gas, bringing coal back online, and just the fact the weather has been milder. Do you see Europe being able to repeat that act next winter, the winter after that, the one after that?
And I think that's a key point, John, is the underlying story is still that Europe and the global market is short of natural gas. In some sense, we got a lucky break this year because the weather was very mild. You come through next winter and there's no guarantee that's going to happen. And so that market remains very fraught. There is some signs, both in terms of the sort of residential heating and in terms of the way businesses are using natural gas in Europe, that's declined. And so some of that may persist. But that underlying vulnerability that that Europe needs to import an awful lot more of its gas via global markets rather than via Russia means that shortage is there. And so prices today, we say, well, that's great. They've come down a lot. They're still double what they used to be. They're still roughly about 5 times higher than in America. And that's at a good time. And there's a risk that they can go higher if we see sort of cold winter next year.
We've got 40 seconds. You can do the Bank of England or Chelsea. It's your choice.
I think Chelsea is just a waiting game, and I'm fully behind the team, and I think this time next year I'll have a big smile on my face.
If John and I are there at Tots Chelsea here on Sunday, can you get us into the BP box?
I wish. I tell you what, if you were, I'd be fighting you first.
Okay.
Hey, Spencer, this was great. Let's do it more often. Spencer down there.
Thank you.
Of the BP Group, and formerly, of course, of the Bank of England. Equity futures right now down 0.9% on the S&P. In the next hour, we'll catch up with Stephanie Roth of JP Morgan, Tony Rodriguez of Nuveen, and Keith Lerner of Truist.
Bloomberg surveillance, much going on right now at this moment in Poland, an historic meeting that harkens back to another time and place. The President of the United States with the allies of Eastern Europe. 1 year on in the battle of Ukraine, the war of Ukraine, I should say. This is an extraordinary moment for those on radio. The American flag's front and center with the red of Poland as well. Lisa, an important note of ally reaffirmation.
And as this happens, we haven't really talked about this. Vladimir Putin earlier this morning saying that he is halting a pact that he has with the U.S., with NATO allies, to allow investigators, inspectors in to observe their nuclear arsenal. And this just sort of highlights the growing fissure between Russia and the rest of the Western world.
The week is so important here that before we get to Mr. Giannone of Barclays, I thought that we should have Michael McKee in here. Not so much on Philadelphia Fed non-manufacturing. I don't see the data. Mike, correct me if I'm wrong. But far more importantly, on the week ahead. And Lisa mentioned she'll read the minutes. I won't. I have to watch Real Madrid play.
Just promise that you would.
But, well, you know, maybe I'll get to it. But there's PCE deflator as well. Are you focused on the minutes? Or are you focused on PCE deflator?
Focus more on PCE at the end of the week, because it's about spending and it's about incomes, and whether or not incomes have started to catch up with or are still way ahead of what the Fed wants to see. Spending, is it holding in there? It seems to be from the retail sales numbers. And then we get the inflation components of that, which are going to be really important. The PCE is, of course, the inflation index that the Fed targets. And so we'll be watching the headline number, but more importantly, the core services housing number, which is the one that Jay Powell has cited as telling them the most about the status of inflation in the economy.
Lisa, this is really, really important. I don't think McKee's ever done that, broken down services into something new. I mean, it's sort of, we're making it up as we go.
The super core, that's basically what you're talking about, right? This is the new measure that the Federal Reserve looks at.
The Fed is actually doing the super core.
Yes, they're called, super core.
They're looking at it, yes, because they think that services are where inflation's dangers are the greatest, because the service industries are still having trouble finding people and therefore pay up for it, and have some wage inflation issues. We saw that today with the Home Depot people talking about, raising payments to people.
Futures deteriorate. You can see that on television, on radio. Let me tell you, futures negative 33, Dow futures, and then negative 300, down 0.9% on the Dow. NASDAQ down 1% as well, and the VIX expands out over 22 as it has all morning, 22.36.
I do want to note that the Philadelphia Fed non-manufacturing activity did just come in way above where it was expected. And Mike, I'd love your just quick reaction before we go to our esteemed guest next.
Well, it's at 3.2 from negative 6.5. And while this is a sort of a tertiary indicator, people don't pay a lot of attention to it. What we've seen in Europe today, and what we're going to be looking for later this morning in the United States, is a rise in service industry measures for PMIs around Europe and the U.S. And what it appears to be is that with the weather as mild as it has been in many countries, there is more disposable income because people are not paying as much for utilities, and that's keeping service industry spending up. So that will be something interesting to follow. Remember, the Philadelphia Fed's manufacturing index took a real dive. So the fact that service industries are hanging in that area is good news for the economy.
In a 4-day work week, there it is, 3, 2, 1. In a 4-day work week, some people can't speak, but I'll try right now. It's important to readjust to the economic data that Michael McKee speaks of. Mark Giannone is hugely qualified, chief U.S. economist at Barclays, but far more, tours of duty with the New York Fed and the Dallas Fed as well. Dr. Giannone, thank you so much for joining us. When you were at Princeton, studying with Blinder in the August, people there were theories that you talked about. Is there an operative theory right now for Mr. Powell and the Fed?
Hey, good morning, Tom, and thank you very much for having me here today. I think the Fed has increasingly used its tool of forward guidance over the past couple of decades and has become more adept about using that. And I think this is a theory that has been largely developed in those days at Princeton, as you mentioned.
Describe the Barclays glide path of supposed disinflation. Describe the glide path and the timeline of that glide path.
Very good. So we of course come down from a very, very high inflation rate. We were running at like 9% CPI inflation last year. Inflation has come down quite a bit over the past year. We are now expecting inflation to overall continue to decrease throughout this year, despite the fact that the last reading have been a little stronger than expected. And we expect the PCE deflator to still show some robust gains later this week. But we expect inflation to year on year come down to around 3% by the end of this year, with core a little higher and headline inflation slightly below 3% on a PCE measure.
Mark, you said that the Fed seems to be gaining little traction against strong labor demand in one of your recent reports. What do you suggest they do to gain more traction over labor markets?
Well, they really have a blunt tool here, which is the short-term Fed funds rate. They can increase that a little more. We expect, in fact, that they're going to increase the Fed funds rate another 25 basis points at their March meeting, that they will continue to raise it another 25 basis points in May, and likely again 25 basis points in June. So, in total, bringing another 75 basis points of tightening in their with their short-term Fed funds rate. In the background, of course, we have the balance sheet continuing to decrease. But much of the control of the economy is really happening more through the Fed funds rate at this point.
You talk about the blunt tool, and it can have pretty blunt and painful consequences, particularly for an employment market that takes a while to return to its full force once it is really beaten up. And I am wondering whether you agree with Mohamed El-Erian when he said, basically, it's not going to be worth it for the Fed at this point to do what it takes to get inflation back down to 2%. And they're probably going to have to settle at a higher rate of, say, 3%. Do you agree?
I feel pretty strongly that the Fed will want to bring inflation back to 2%. They are determined to do that. It's going to take a little longer, but they are absolutely determined to do that. I don't think that they will settle for 3% inflation. And the reason for that is that they've really have benefited tremendously in this recent episode from the fact that inflation expectations have been anchored at 2%. And if they were to deviate from that, if they were to give up on that, on achieving 2% over time, most likely inflation expectation would be drifting up, both across financial markets, household firms, professional forecaster would be revising the inflation expectation up, and that would be extremely costly for the Fed over time.
Mark, a couple years ago, good number of years ago, with the wonderful Jean Bovin over at BlackRock, I assume the two of you at Princeton at the time, you wrote a paper on the disaggregated. To me, this is a key point coming out of a natural disaster, a pandemic. Do we aggregate in our analysis, or are things so messed up that we have to disaggregate labor, disaggregate monetary policy, disaggregate the equation of GDP? Do we disaggregate here, or do we sum up as we're used to doing?
So ultimately, when we think about the Fed in particular, I mean, they are interested in bringing the overall inflation, meaning headline PCE inflation, back to that 2% target. But in order to understand the dynamics, we have to, of course, disaggregate. And this is particularly relevant in the most recent episode where we've had services and goods evolving in a very unusual way due to the shock that hit the economy, with the services prices initially declining, but then increasing more rapidly, and goods prices doing the opposite, falling very, very sharply initially, and then rebounding very, very strongly due to the supply chain issues. So we have to go look under the hood and look at the details of the disaggregated component to understand really the dynamic for the aggregate as a whole.
When you disaggregate, perhaps we'll find rolling recessions in different sectors that add up to perhaps less robust growth than you might expect, but not a wholesale overall recession. Is that your outlook? Do you still fall into that despite the blunt tool the Fed has and the desire to get inflation down to 2%?
Well, that's a very good point. So we've seen the tightening in financial conditions, the increase in rates having a very rapid impact on the housing sector, reducing housing demand last year, having a significant impact on starts, on permit issuance, and so on, and affecting activity in the residential sector. So we've seen that very quickly. But I think underlying your question is the fact that more broadly, we haven't seen a recession. We see consumption still growing very, very strongly, very robustly. And that consumption is actually fueled by this very tight labor market that generates a lot of income and fuels consumption. So we expect that to eventually slow down as the rates go up, as the Fed continues to tighten its policy. We've seen indication from the survey of senior loan officer opinions suggesting that there is tightening in credit, continuing tightening in lending standards. So we expect that to overall slow down the economy more broadly, and to result in mild contraction in economic activity later this year.
Dr. Giannani, thank you so much. He is with Barclays this morning. Lisa, I think that's so important. And, it's just another research paper along the way. But when he and Boivin were students at Princeton and just out, whatever, this idea of should we look at these statistics all in or disaggregate is a huge, huge question right now.
Especially because we are seeing these rolling recessions. The goods economy is completely distinct right now from the services economy on many levels. You look at very different patterns, a very different cycle, and this is because of the pandemic. This is because of a lot of the purchasing power that was brought forward. But how do you parse that out if you're looking at an overall figure?
You've gone to the heart of the matter, which is if you parse out goods dynamics and services dynamics, every viewer and listener knows we're living service inflation. We don't need to be lectured on that. The issue is goods is turned with a vengeance, read David Rosenberg, and services, we've really yet to see the evidence of a service inflation turn.
And now we're even seeing some reinflation in certain areas of the goods side. So again, it's sort of how do you game this out? And then you throw on an energy situation. I don't know, a lot of uncertainty.
We continue. Futures deteriorate -34. The 10-year yield 3.88%. Higher yields this morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the New START nuclear weapons treaty with the U.S. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. Goldman Sachs sees the Federal Reserve raising interest rates by a 0.25 percentage point at its March, May, and June meetings. The bank's chief economist, Jan Hatzius, told Bloomberg that he also thinks there will be no rate cuts until 2024. Hatzius cited higher inflation numbers for January. In the euro area, business activity rose at the fastest rate in 9 months in February. That's raising the likelihood that the bloc can avoid a downturn this quarter. Both France and Germany returned to growth after likely pullbacks in January. And Microsoft is heading into a showdown with EU regulators over its $69 billion takeover of game maker Activision Blizzard. The software giant says the deal will lead to more competition for gamers. At the same time, Microsoft is pledging to show willingness to address antitrust concerns. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We are concerned that China is considering supporting Russia's war effort in Ukraine with lethal assistance, something that we're watching very, very closely. This would be a real problem for China in its relationships with many other countries, not just the United States. So we hope and expect that they will forbear from going down that road.
The President of the United States is in Poland. The Secretary of State of the United States, Antony Blinken, speaking on China this morning in his difficult meetings that we've seen for it. It has been an eventful day. Our Anne-Marie Horton, our chief Washington correspondent with the president in Poland. We have seen the pageantry there, and of course this meeting of the 9 members of Eastern Europe. But the focus must be, and maybe, Lisa, do you agree, off the radar a bit, is this China-Russian U.S. axis. It's just not being discussed enough as a sum total.
I would agree. That was the one thing that caught my attention over the weekend. That was the most concerning, that suddenly this is an even greater rupture between the U.S. and China that raises a new specter and a new tension. As John put it, the potential for a proxy war being played out in Ukraine.
Someone with perspective on this with AGF Investments, the chief U.S. policy strategist, a morning read for All in Washington, Gregory Vallier, joins us this morning. Greg, it's real simple. As you know, the first year of a war, there's a tone. And then the second year of a war, it's different. What do we do on spending, on defense spending in the second year of any given war?
Well, it suddenly is a much more relevant question, Tom, because everyone had assumed maybe defense wouldn't get as much as they have in this new fiscal year. They're up to $850 billion. They got a 10% increase. And lo and behold, we heard comments from Blinken over the weekend and hints that China may aid Russia. If that does occur, I think that it would be a serious rupture, and I think it would lead to still another big chunk of defense spending. We might go up another 8 or 10%, focusing on shipbuilding, focusing on the South China Sea.
You know, well, that's right where I wanted to go. I hope I've got the spelling right there. Correct the spelling, Amy, if you would. My fractured spelling, Greg, as you well know. What it comes down to, and to tie it together, is Ukraine, the Philippines, and China. And that we've decided we're going to build 4 bases in the Philippines. The New York Times had an article on this weekend. I mean, the U.S. is projecting towards China, aren't they?
Yes, and I think that any chance that we would have lifted some of the Trump-era sanctions is gone. In fact, I think there's a chance we could have even more sanctions against China.
What did you make, Greg, of what Tony Blinken said? I mean, basically, they are seriously concerned that China could be actively considering sending more support over to Russia, and that includes perhaps surveillance support. This is sort of on the heels of the whole balloon episode. What do you read into that?
Well, I think it's ominous. I would worry if we went down that road. And by the way, the North Koreans sending missiles over northern Japan isn't even on the front page. That's in on the back page. So there's so much tension right now. I see some people in the U.S., some Republicans saying we can't spend that much more on defense. But I think Biden has the votes. I think he has the votes in the Senate. He's got enough Republicans there to get him a big increase in spending.
This could potentially go to expanding a presence in the Philippines. This could potentially go to expanding a presence with a number of allies in the Southeast Asian region. But this also speaks to what is going to be the relationship between business and China, and also with the U.S. and Germany, because Germany depends a lot more on China. Do you have any visibility into, particularly on the business side, whether they're going to be more aggressive, the U.S. administration, on pushing back in expansion in China?
My sense, Lisa, is that they will. It's maybe avoidable, but I think U.S. businesses are going to have to anticipate a much more hostile climate for the foreseeable future.
I look, Greg, and of course it's all foreign exposure with the president in Poland right now meeting, but I think we need to bring it back. How good a week did Governor Haley have of the South Carolinas? I mean, she made a splash X number of days ago. What is the now what for the candidate Haley and the other candidates ready to jump in?
That's a good question, Tom. She had a great opening day. As the week went on, there were more people picking at her record and inconsistency on racial issues. But that said, I think she's a fresh face. I think she's going to have some some traction here over the next few weeks, but there are more people coming in, whether it's Pompeo or Mike Pence.
Right.
I think she doesn't get to have the stage all to herself. And it now looks like DeSantis is really gearing up. He had speeches over the weekend against crime, and now his comments on not spending as much money on Ukraine. So it's a crowded field.
Do you see any evidence that the former president, Mr. Trump, has lost his audience? I don't see any evidence of that. Do you?
He's lost a little. What surprises me is that he's been relatively quiet. No nasty nicknames, no outrageous, bombastic statements. By Trump standards, this has been a kind of a slow period. You wonder about why. I think it's temporary. I think he's still in it to win.
And on the Democratic side, I mean, here's a president, to be kind, more than active, with the symbolism that we saw in Kiev this weekend and what we see in Poland now. What does he return to? An announcement well-timed?
I think he'll wait till April. That seems to be the consensus, Tom. He had a great weekend. I mean, for him to take the 10-hour train ride both ways to go into a war zone, you got to give him credit for a chutzpah. So I think he clearly is the nominee. There might be a fringe candidate or two, but barring some kind of a health issue, the nomination is his.
There's been a number of critics who have said that perhaps President Biden's focus isn't focused enough on the domestic sphere, particularly what happened in East Palestine in Ohio, and that he is too internationally focused at a time where there are all of these major conflicts. Do you think that that could hurt him as he becomes potentially the next president yet again?
Well, it could. I mean, obviously, he wants to get inflation even lower and get the economy stronger. He doesn't want to see the Fed raising rates too much more. But I would say this is going to be a year, guys, where geopolitics dominates. It will be the big story. It will eclipse most economic issues.
And you think that it's going to be more on the spending on defense and on the sanctions front, not necessarily on the actual hot war aspect of it. Is that correct?
Yeah, and again, I think that the defense budget is probably going to get another 8 or 10% in this new fiscal year budget.
Greg Valliere, thank you for the brief. Just hugely valuable on an eventful Tuesday with AGF Investments, Gregory Valliere, this morning. Lisa, this whole foreign-domestic dichotomy, as we shifted there from what we've seen in China, what we've seen in Russia and Ukraine and Poland this morning, over to who's going to run for the Republicans, just shows you the abruptness of the moment.
The fact that Greg Valliere, though, is basically saying geopolitics will dominate is really telling to me, because what we're seeing right now is the kind of tension that we haven't seen since the Cold War. And that's the language that they're using right now, with China saying people are acting like a Cold War, and Tony Blinken coming out over the weekend and saying, no, we have no intentions of going back to a Cold War type of mentality. But this is these are the stakes that people see right now.
What's interesting to me, and to your great observation, is the cardinal rule is geopolitics doesn't matter for the American electorate as they move through October, after Labor Day through October, towards November. But then there's one huge exception as we celebrate the life of President Carter. He's grievously ill, resting at home in Plains, Georgia. And that's all great, except we have to remember Mr. Carter was overwhelmed by international relations when he, in that huge landslide defeat to Ronald Reagan, having to do with the terrible Iranian hostage crisis.
Well, you think about the current moment and where we are with respect to an increase in a fissure between U.S. businesses and China. What does that do for inflation? What does that do for some of these business models in some of the preeminent U.S. companies that are intimately connected with China?
Are we going to hear a different story tomorrow from Edward Hyman of Evercore ISI? We heard a lot of caution today, I think, led by Mike Wilson, the 3 rate rises of Goldman Sachs as well.
There are plenty of bulls out there who say this is the beginning of a bull market, that we're looking at real sustainable growth. Yeah. And I just think that there is a distinction between the economy versus markets. And for a long time, it was markets over the economy. And is that shifting a little bit as we enter an inflationary period?
So much for a slow 4-day work week. It is not slow. These markets are shifting here and deteriorate. S&P negative 37, down negative 333 points. The VIX ought to stick 22.40. The 10-year yield now up to 3.89%. Stay with us. This is Bloomberg Surveillance. Good morning.